today.
If you want your family to be as resilient as possible, it's important to take some time today and visit mendoready.org, where you can look up your pre-established evacuation zones on our current emergencies map. You can also find important tools to help maintain your situational awareness, such as the Alert California wildfire cameras and the Caltrans road conditions cameras. We hope you'll take some time today to prepare so that your family can be Mendo ready. Thank you.
Are you prepared? We're the Office of Emergency Services, and we're committed to providing the most up-to-date and accurate information so that you and your family can stay safe during an emergency. Visit MendoReady.org. It's our one-stop shop for emergency information. You can sign up for emergency alerts, find your pre-established evacuation zone on our current emergencies map, and find hazard and preparedness information.
Imagine you're faced with a disaster such as a wildfire and you're ordered to evacuate. I'll bet you wish you had more time in that moment. Now's your chance to buy yourself that time. Sign up for Nixle and Mendo Alerts on our website, MendoReady.org. Do it today.
If you want your family to be as resilient as possible, it's important to take some time today and visit MendoReady.org, where you can look up your pre-established evacuation zones on our current emergencies map. You can also find important tools to help maintain your situational awareness, such as the Alert California wildfire cameras and the Caltrans road conditions cameras. We hope you'll take some time today to prepare so that your family can be Mendo ready. Thank you.
(2024) is called to order at 8:30. Ms. Seller, please take the roll.
Mr. Land?
Here.
Mr. Kelly? Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Mr. Cromer is absent. Mr. Shoemaker? Ms. Harris?
Here.
Mr. Swope, and Ms. Pierce is also absent.
Okay. Let's see. Mr. Swoop, would you like to lead us in the Pledge of Allegiance? To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, public comments on items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda. The board is prohibited from taking action on matters not on the agenda, but may briefly answer questions. Do we have any members of the public wishing to make comments at this time, Ms. Seller?
There is no public comment at this time.
Okay, the consent agenda will be approved by unanimous consent unless a separate action is requested by a trustee. Does any trustee wish to pull any item from consent? Consent agenda is approved by unanimous consent. Okay. Item 2, discussion and reading the historical benefit review project status report and project updates. Executive Director Rentschler.
Thank you, Chair Cavness. The report for February is in your packet. There were only 2 corrections completed in the past month. If you have any questions regarding the report, I'd be happy to answer any questions you have at this time.
Do we have any board member discussion on this item? Any public comment? Is there a motion?
There is no public comment. And no motion required.
No motion required.
Okay,
Just receiving.
all right, received and filed. Okay, discussion and possible action regarding investment matters. Quarterly investment report summary and small to medium review from Callan, Greg, Claire, Anna. No, Claire is not here. Okay, good morning. No. Wow.
Yeah, so it's me and Hannah. I share pictures with anyone. Claire would love that. He had a little boy, Will
Aw.
Crawford. He's doing great. Okay, so we've got a few things to talk to you about today. The first is we're going to talk to you about capital markets and then performance through the end of the year, calendar year, as opposed to fiscal year. We're going to provide an update on the small and mid-cap manager search that you instructed us to do. And then we're also going to spend a few minutes talking about our full performance report. So we create a summary presentation for you, and the purpose of that presentation is to summarize information and to have you focus on a few topics as an oversight, right, board. But we have this full performance report too, and we just wanted to make sure you know it exists. And it has a lot more data than the summary presentation we give you. So we want to share it with you to just make sure you know it's a reference for you if you ever want to look at it. Okay, so those are a few of the items we're going to talk about today. So, thank you. So let's flip ahead to 3, if that's okay. Wonderful. So this is what the world looked like at the end of the year in terms of capital market returns. And you'll see it was a really strong quarter for pretty much every asset class with the exception of real estate. And for the 1-year time period ended at the end of the year, you'll see extraordinary returns. So the Russell 3000, that's the benchmark you use for your total equity, U.S. equity portfolio. That was up 26% for the year ended in December. Now, look to the number right immediately to the right of that. So that's the 2-year return. That's the 2022 downdraft and the 23 snapback. And you'll see that actually we just barely eked out a positive return for that 2-year time period. And this was all in the face of the time when everyone was calling for a recession. Like I was here 6-9 months ago, right? And everyone said a recession's going to happen. Increasing interest rates. The Fed's going to cause a recession. They have to do it to bring down inflation. And lo and behold, inflation's come down, interest rates have gone up. But last year we had a really strong return. So what's the lesson for this? Don't try to time the market, right? You'd be dead wrong and you would have missed a 25% rebound in the U.S. stock market. So stay humble with your predictions and keep your asset allocation for the long run. So that's the big lesson I get from what happened over the last 24 months. Let's look at the difference between large cap and small cap stocks, because it's actually meaningful for your portfolio. Look at the S&P 500. Those are the 500 largest companies in the U.S. And then the Russell 2000, it's 2,000 companies smaller than the big 500. And over the last year, you made 17% in the Russell 2000. Is that bad? No, it's actually pretty good. But it does look bad relative to U.S. large cap stocks, relative to that 27% return. So a big difference between large cap and small cap over the last year. And really, you'll see that this has persisted for the last 10 years. The small cap premium has not existed for the last 10 years. And that's disappointing. And it's really been driven over the last few years, is really driving that cumulative number because of the Magnificent Seven. You've all heard that term by now, right? NVIDIA, Microsoft, Google, they're driving the market. Those 7 stocks are accounting for 3/4 of the return in the U.S. large cap market. And the small cap market has not participated as much. Now, having said that, over the last 10 years, it's produced a 7% compounded return per year. So it's done okay. It just hasn't been as good as something else. Why am I dwelling on this? In our investment program, we've just got a little bit of an overweight to small cap relative to large cap. It's something we've talked to the board about historically. And when we did the equity structure review, we noted, well, this is a tilt that we have in the portfolio. And we have that tilt because over the long run, we think the small cap premium does exist and will return. So I bring it up today because it drives a little bit of your equity portfolio relative performance. If you look at your equity managers underneath the hood, most of them have actually performed pretty well. But the issue is that we've got a slight overweight to small cap. When I say overweight, it's like 5%, something like that. It's not huge, but it's enough to make a little bit of a difference. Let's look at a little lower down. We also have global equity, so international equity. Again, nice returns, but not quite what we got in the U.S. large cap market. But can we complain about a 8.5% return per annum for the last 5 years? It's not bad, but it's not quite as high as the U.S. large cap market. Fixed income on the next category down. What a huge quarter. up about 7% for U.S. investment grade bonds. Interest rates came down. And that pulled the one-year return for bonds into positive territory. So really strong return for fixed income in the quarter, and for the year up about 5.5%. The problem area is in real estate. You'll see for the quarter, the NCREIF property index is down about 3%, and for the year, it's down 8%. So there's been notable headwinds in central business district buildings, COVID-driven. There's been notable headwinds in some of the major metropolitan areas, in particular in that category. So back in the day, so a year ago well, let's just say pre-pandemic, you wanted to be San Francisco real estate. You wanted to be New York real estate. You wanted to be on the coasts, right? And those are some of the areas that have been hardest hit in depreciating value for office, specifically office space. I bring that up because one of your managers, your real estate managers, is really struggling right now, and it's because of 3 commercial properties that they own that were written down meaningfully. So that's why I bring that up with you. We have a few other asset categories on this page. Let's look at inflation, though. Inflation has been a huge issue for us, and it's just in the last few weeks, it's been stubborn and coming out and proving to be a little higher for longer than what we wanted. That's caused a big repricing in the bond market and some equity markets over the last few weeks when we had inflation prints come up a little stronger. But the one-year inflation for CPIU, they're all different types of inflation measures for CPIU. For 1 year, it's 3.35%. It's come down meaningfully, and but what we're, I think, starting to really recognize and feel is that last mile, that last 1% is going to be hard for us to get down to that 2 to 2.5% from that current 3.3% number that we have now. On the next slide, we share with you the economic growth and inflation and yield curve. And we always share this because in the long run, this is the factors that'll drive capital market returns. Notably, for the fourth quarter, GDP remains really strong, positive 3.3% for the fourth quarter. And that's while inflation is starting to come down. A little bit of fun math for you. What's the nominal growth rate of the U.S. economy right now? Right? We know the real growth rate is 3.3, and you know inflation, let's call it 3.5%, 4%. That means the nominal growth rate is about 7% right now. So the average company in the United States is growing by about 7% right now, right? So the average company grows at about the GDP growth rate, real, and then they can pass on inflation, the average, on average, not every company, but the average company. That means they're growing by about a 7% rate right now. So that's pretty supportive to the equity market going forward, right? If you're a company that can pass on inflation with your pricing. Not every company can do that, right? In some areas, inflation's higher than others. Oil's been very weak. That's a bit of a headwind for oil companies. But there are other companies that can pass on their inflation. So very supportive right now. Okay, so on slide 5, this is a chart we like to look at once a year, and it's fun to kind of look at and think about. So what this chart shows is the return for the U.S. stock market broken out into 10% increments. And the most recent years are at the top. The years a long time ago are at the bottom. And we just plot them. And lo and behold, they kind of look like a bell curve. Who took stats? Looked at these things, right? It's a flashback here for you. And lo and behold, the stock market does kind of look like a bell curve here, right? And the majority of the time, the heart of the distribution is to the right of zero. That means you should expect a positive return. And on average, it's around 10%. That's the median, or the mode, or whatever we call it, stats. People can correct me for that. But then we could look at individual calendar years too. That's the average, but 2022, not too long ago, we were down 18% for the year. And then 2023, we're up 26%. So it wins on average, but taking capital market risk, this distribution shows you what it is to be an investor. You've got to be able to survive the negative 18 to reap the benefits of the positive 26. And over the long run, it works, but you need to be diversified and make it to the long run to have it all pay off. The next several slides go into detail about the markets. And I tell you what, I'm just going to flip ahead for those. And then we'll just start talking specifically about your plan. That's okay. So we'll go to slide 10. I think Hannah was going to take over at this point.
Greg. So starting on this slide, we transition to the MSARA plan and the total assets and performance. Looking at the top chart is the cumulative time period for the past 15 years. Looking at ending market values. You'll notice after 2019, with the start of COVID, down sharply, and then up again, and back down, and up again. So it's been a volatile past 3 or 4 years. But in general, we have trended upward and ahead of where we were pre-pandemic. Looking at the chart at the bottom of the slide is the fiscal year to date, which is the past 2 quarters. At the end of last year, end of 4Q, December 31st, the total portfolio ended the quarter just shy of $684 million, up about $20 million from June due to $25 million in investment returns, notably all positive with the exception of real estate. And then we saw benefit payments of about $5 million for the past 2 quarters. Looking at the next slide, we have the actual versus target asset allocation for the portfolio. On the left is actual and the right target, and the bottom more detailed look. We are slightly overweight infrastructure, but that is offset by slight underweights in domestic equity, fixed income, and international. But importantly, we're all within policy guidelines and close to that of the target. Looking at the next slide, we show historical asset allocation. You can see that we added infrastructure in that orange-yellow color, and we've also decreased our allocation to fixed income and international equity over time. On the next slide, we look at the peer group and how the MSARA portfolio compares versus our Callan Public Fund sponsored database. Importantly, we are in all the major asset categories as our peers in domestic, fixed income, real estate, international, and then also in real assets, which is your infrastructure allocation as well. Compared to peers, we are overweight international. You can see we're at the 15th percentile, around median, actually below median, so we're underweight fixed income, and then a little overweight domestic.
So I have a question on that point.
Mm-hmm.
So I kind of want to make sure the board's thinking about that. So we are overweight compared to our peers in international equities. International equities, from what I can see on Portfolio Visualizer, are at least as volatile, maybe more volatile than the U.S. stock market. They're certainly more volatile than the S&P 500 in the U.S. stock market. So what's volatility? Well, if you look at the Callan report, it's sometimes defined as standard deviation. and Callan's report often refers to it as either risk or standard deviation. So when they use the term risk, they're often referring to standard deviation, which is, I would say, the frothiness of your investments, is another way of putting it. So anyway, but international equities, we have more than many of the other public pensions, and it is, by and large, more frothy, more volatile, more standard deviation, more risk, as Callan might even put it, than the U.S. stock market. Doesn't say, that's not to say you can't have international equities, but just know what you're buying when you're buying international equities. You're buying something that is going to be more likely to be more volatile than U.S. stock market, and you're adding that to the mix. And we're overweight. State of Nevada is a Callan client. I don't know, Greg, if you've ever spoken to the state of Nevada's pension fund. Do you?
Yeah, I have spoken. I don't work with them. They're
And why I'm mentioning the state of Nevada is they're recognized in many media reports as being one of the highest performing public pensions in the United States. And they're also famous for using largely low-cost index funds. They're, just as a point of reference, they only have 16% of their portfolio is international equities, less than we have.
Yeah, and there are a few points in there, and Nevada's done great, and we're very happy for them. And we have worked with them for a long time, and they do have a distinct philosophy about active versus passive, where you spend active risk. Now, notably, so when we're overweight, what we're saying is you have more than the average of a peer group, right? So it's relative to other plans like yours, right? And you have more domestic equity. The target, 37, so you're about 4% more in domestic equity than the median. And international equity, you're about 5 or 6% more in international equity. The average plan out there, right? And what do you have less of, right? You have less fixed income. That's by about 3%. And then you have a lot less of the other stuff. And I think that's, like, if you didn't have more in international equity, more in domestic equity than other plans, you would have a bunch of the investments in the other categories that we're showing here. So private equity, hedge funds, global equity, alternatives.
That's as it relates to our peers. But if we were to look at state of Nevada, again, one of the highest performing public pensions in the United States, renowned in many media coverage year after year, often in the top 5 of all pension funds in the country. They don't have a lot of money in alternative investments such as private equity. They have a little bit. I think it's about 9% of their investments is in private equities.
Yeah.
But they have, I think it's 42% in U.S. equities. And what are their U.S. equities? Do they pay for expensive investment funds? No. Their U.S. equities is entirely the S&P 500 index, paying, I think it's 2 or 3 basis points, almost nothing for that investment. And they only have, again, 16% of their portfolio is international equities. Again, just a cheap index fund. They're not paying high, expensive managers for their international, and yet somehow miraculously, with those cheap funds, they're outperforming almost every public pension fund in the country, including ours.
Yeah. All factual comments.
Is there any public comment? No.
There is no public comment at this time.
Okay.
Next slide, we can look at the detailed asset allocation for the individual funds within the portfolio and then the total portfolio. As I mentioned earlier, the portfolio at the end of the fourth quarter was just shy of $684 million, up from about $639 at the close of the third quarter. Throughout the quarter, we saw investment returns of almost $46 million, all positive with the exception of real estate. And then in the net new investment column, we saw outflows of about $1 million. And domestic equity,
So the one thing just wanted to point out here is that you do have a significant allocation to passive, and your largest fund you invest in is 25% of the total is in the S&P 500 index fund. Doesn't mean you're exclusively passive, but your largest allocation is 25% of your money is in one S&P 500. So just wanted to point that out.
So Greg, another way of putting that is 70% of our U.S. Domestic equities are
No.
It's not 70%?
No, so 25% of your total plan.
I know, I get that. 25% of portfolio, or alternately, another way of putting it, of our domestic equities, 70% is in the S&P 500 and 30% is in actively managed, expensive domestic equity managed funds. Whereas state of Nevada, 100% of their U.S. domestic equities is in the S&P 500, a cheap index fund. Of their domestic equities, 100% of state of Nevada's is the S&P 500. Of our domestic equities, 70% is the S&P 500, and 30% are expensive mutual funds for small and mid-cap.
Robert?
Well, so I would pipe in here and say that they're not expensive. They're expensive compared to an ETF, no doubt about that. But for a mutual fund, these are sort of middle of the road-ish.
Well, I read Morningstar, and they say anything you pay over 25 basis points is considered to be a little bit of a risk that you're actually going to get your money back on the 25 basis points or more.
And I'm sure that they're talking about ETFs on a personal basis.
Well, same thing. It's an investment.
No, it's not.
There's no difference.
The tax treatment for an ETF on a personal level is way different than a tax treatment on.
We're talking total performance, regardless of the tax consequence. You're unlikely, it's proven that you're unlikely, not that you can't, but you're unlikely to outperform in total performance with an actively managed fund if the actively managed fund charges more than 25 basis points over a long period of time, 10 years or more. If your investment horizon is that, then your odds of beating a cheap index fund go way down. It's only like, what, 2 or 3 or 4% of all actively managed funds, and those that do beat the index are almost always less than 25 basis points.
Well,
I don't want to debate that, but I do want the board to understand that the fees that we pay for our mutual funds are not expensive. They're relatively expensive compared to what Trustee Jurdy has mentioned, but when you look at the spectrum of costs related to mutual funds, they're not.
What would you say our average cost, if you were to blend our 30% of our U.S. domestic equities that are in actively managed funds, would you say they're 70 basis points?
20 something.
I think they're more than 20 basis points. I'd like to, can you produce that at a future report?
Sure.
Okay, thanks.
next slide, we have performance for trailing time period group. For the last quarter, the total fund returned 7.0%, and for the year, up 11.6%, trailing the benchmark. And then for longer time periods, ranked about median for the 3-year, and then for 5, 7, 10, 15 years, closer to that upper quartile, and in the 15-year scenario, top decile. For the last 10 years, we've annualized almost 7%, and for 15 years, annualized a healthy 9% return.
And these are net fees too.
Can you clarify, these, the report says are annualized returns? Can you clarify that that is not the same thing as geometric returns? Or not the same as compounded returns?
They are annualized geometric.
Okay.
They're compounding.
So to clarify, okay, so let's just take a simple example. So I put $100 into a mutual fund. The first year it drops by 20%. So now after year one, it's worth $80.
Yep.
At the end of year two, it's grown another 20%. So is the annualized return 0 because it's gone down 20 and up 20? Because my actual investment is only $96. It's not $100 anymore.
Be -2.
-2, because annualized over 2 years would be 2%. So you're, in this report, when you're saying annualized, that's not the same thing as compounded then? Because what we just described would be compounded -2%. Okay, so you're saying,
Annualized, I don't know the difference.
so when you say annualized, you are saying that's the same thing as compounded?
Yeah, I mean, I don't, maybe I'll try to get your point on definition of those words. But these are linked geometric annualized. Okay. So in your example, it's the -2% number. It's not 0.
Okay,
Did
so
that
these
answer your
are
question?
taking into account when the market, because the market goes up and down. So this is taking into account, so it's an annualized.
This is not the average return. It's not the return divided by number of periods. It's a compounded.
Okay, so is there a difference between this and the CAGR, the compounded annual growth rate?
I don't calculate your CAGR. I would have to look at the CAGR and calculation.
So this may or may not be the same thing as a CAGR.
I don't know. Who calculates your CAGR?
Well, CAGRs are commonly used investment.
So compound annualized
Growth rate.
Mhm. Yeah, I don't know where you're going.
Well, it's just that's often what a private investor would be looking at, is what's their compounded annual growth rate.
So there's something called an IRR, internal rate of return. That's where you take beginning and the ending market value, cash flow along the way, and then you go through an exercise and say what is the average annual return you must have achieved over that time period. That's not a time weighted. So that's not what we're showing here. We're not showing an IRR here. We are showing a time weighted on this slide.
Okay, so, okay, well, thanks for the clarification. And just point out, I think most of us in the room are aware this is a really fortuitous 15-year look back. Everybody wishes we could have a look back like this, because it's after the great financial crisis.
Yep.
And there's been a long run since then without something equivalent to it. I mean, granted, we had the COVID dip, but that was like the hockey puck that went down and back up in 2020. So we haven't had any traumatic impact to investments in the same way that we had with the 2008 Great Recession.
2008 was unique.
Is there any public comment?
So
There
I would
is
point out
none.
one additional thing. This time period does include the market bottom, which was generally in March of 2009.
Yeah, I know. But you had the bulk of 2009.
close.
Bulk
It's
of
close.
2009, it was going up.
It's close. It's close to the bottom.
2009 was still a good year.
Turn your mic on, please. I can't hear you. Could you turn your mic on, please?
Yeah, my voice is shot too. Excuse me. If we put last year's similar chart on the board, would that 15-year number be significantly different based on having 2008 included?
It would have been lower because you would drop off this past year. 11.5% return positive.
Mm-hmm.
And you would have added, and I'm sorry. Where's our, so, yeah. Yeah, and you would have added 2008 down. So this year's 15-year return looks higher than last year's. And I'm sorry, I don't have the number in front of me, Richard.
That's okay, but you answered the question.
Okay.
Thank you.
Yeah.
On the next two slides, we show the past 10 fiscal years. Notably, 8 out of the last 10 fiscal years were positive, and for fiscal year to date, we're also up 4%, but trailing that the benchmark, mostly due real estate down sharply. Moving to slide 19, we look at annualized risk versus return. On the left, we have for the last 15 years, the green being the total fund target, and the blue, the MSARA total fund, achieving returns similar to that of the target, but with more risk. And if you look at the most recent 2 3/4 year, which is when we added infrastructure to the portfolio, we've been able to move that risk closer to that of the median, so of the peer group. So the crosshairs represents the average fund of your peers, which now we are closer to that.
And I've just distributed to the board, and I hope you can guys get a copy. I had 12 copies printed, so hopefully there's enough for you. I've taken your chart on the left, and I've superimposed what the risk return would have been with two alternative portfolios. One is a hybrid of the state of Nevada's pension fund, is sort of hybridizing their fund with the best of their fund with the best of ours, keeping it simple, just three funds and 4 funds, and then just 3 U.S. funds, U.S. only, and showing that we could have achieved the same standard deviation, almost 12.42 versus 12.3 over those 15 years, but with a return of over 10.5 annualized return versus 9, and that's the hybrid with Nevada. And if we had just gone with 3 U.S. funds, so SB 500, U.S. bond index, and what Warren Buffett calls moat stocks or quality stocks, and I just put as a placeholder a cheap Vanguard fund that's been around for a long time. There's other funds like that. Those 3 funds would have earned, had a standard deviation of our target, which was just 11.3. But so we would have achieved our standard deviation target, but we would have outperformed our portfolio. Instead of 9% annualized returns, would have had annualized returns of in excess of 11%. So I've included a link. I apologize I wasn't able to paste all the charts I had prepared, but I have a hot link, and I sent it by email to Judy so she can post online and distribute to the board so they can look at Portfolio Visualizer themselves to verify the information I just said. But basically, I'm just showing with cheap, commonly available funds, we can achieve the very same or better standard deviation and have higher overall returns than we are with our more expensive funds that we're paying for.
I have a question as to the composition of the hybrid, because I just would like a little more elaboration on what you did to achieve the hybrid.
So I took the state of Nevada's fund, which they have very few funds compared to us, and I took some of what we do. So
some.
Okay, so I'll clarify. So they have fewer international stocks. So I took their smaller allocation to international, which is 16% of their portfolio. We have more. And I took our slightly smaller allocation than they have to bonds, which is 21%. They have, I think it's around 30% or 29% to bonds. So I took the best, what I felt was the best of both, and then everything else was allocated. What was remaining was allocated in the hybrid just to the S&P 500. They have a fourth thing in their fund, which is about 9% of the portfolio is private equity. I couldn't plug in private equity into something like Portfolio Visualizer to get past performance because it just isn't a publicly available fund to invest in. So that's where I'm calling it a hybrid of the state of Nevada fund. It's very close to what they have, and it's got some of what we have and some of what they have. But it's a simplified fund, and you can see the standard deviation is what we had basically. And it outperformed us by about 157 basis points. I think it was about 10%, 0.57. So it's 157 basis points annualized returns higher than we had over a 15-year period. And then the 3 funds is really simple. It's just 3 U.S. funds. It's just the SB 500, It's got some quality, a quality mutual fund, which you can get it today, you can get it in an ETF. It just doesn't go back to the 2009 in ETF or index version. And then the remaining was just the U.S. bond index fund. But again, there's a hot link in the email I sent out that hopefully gets distributed to the full board, and everybody could go directly to Portfolio Visualizer and see exactly what the fund's tickers are.
Okay, any other comments? So we're going to change gears and start looking specifically at your portfolio and the managers you have within the portfolio. And on slide 21, these are your equity managers. And your portfolio is benchmarked to the Russell 3000. So those are the 3,000 largest companies that are publicly traded. And you'll see in aggregate, your returns look a lot like it over the long run. Over 15-year time period net of fees, you have outperformed it by about 30 basis points. And so this is the domestic equity. Now, over shorter time periods, there's some noise around it as well. But in aggregate, you've outperformed more time periods than you've underperformed the Russell 3000. As Hannah mentioned earlier, you've got this big allocation to U.S. large cap. And that's actually something we changed a little while ago. You used to have more active managers, and you also used to have this equal weighted benchmark. I don't know if you remember that, but we got rid of those a few years ago. And the portfolios performed pretty well because those decisions made. Okay, so we've got a big chunk in U.S. large cap passive, and then we have 4 small and mid cap managers. And if you look at the managers relative to their indices, in aggregate, net of fees, they're all beating their respective indices. So they're beating the indices that they're given to manage against, but they have lagged the S&P 500. So is that the manager's fault? We give them an index and say, go beat this index? Or is it that we had an allocation, dedicated allocation to small and mid cap? It's more the latter. So the managers have actually done their job. We have a slight overweight to small and mid cap, and that's from time to time been a little bit of a headwind. Now, having said all that, over the last 7 years, you're up 13% annualized, and the index is up 12.8. So you've actually outperformed. And over 15 years, we mentioned that. And as Hannah showed earlier, over 15 years, you're in the 10th percentile of your peer group. Your total investment program is in the 10th percentile. You'll always be able to find someone who did better, but you did better than 90% of other public funds out there.
So Greg, I thought you just said that we are slightly overweight small and mid cap. Is that what you just said? So I just did a Google search. S&P 500, at least today, is valued at 80% of the U.S. stock market, but we have 70% of our U.S. equities in the S&P 500.
Right.
So I would say that's going from 20% weight to 30% is not a slight overweight of small and mid cap. I would say it's pretty significant.
Okay. Yeah. I mean, 10% overweight. Yeah.
And again, when you refer to being overweight, you're talking about us compared to the average public fund.
Well, I'm saying you relative to the Russell 3000
Okay.
index.
In your earlier discussion, you were comparing us to other plans. This one, you're comparing us to the Russell 3000
Correct.
benchmark. Okay, thank you.
Correct, correct.
I'm just wondering, I mean, again, state of Nevada doesn't even bother with small mid cap. They're looking at just the S&P 500. And there's a debate, there's an never ending debate on whether or not someone could just invest in the S&P 500 or the total US stock market, or do what we're doing, which is index the biggest companies and have active managers on the small funds, on the smaller companies.
Right.
They're not necessarily really small companies necessarily, but they're smaller relative to the 500 biggest.
Right.
And that debate will probably never be conclusively decided. I'm just pointing out that I think that having 30% of our U.S. public equities in small and mid cap is not an insignificant decision by this board. If their value of the U.S. total stock market is 20%, I think it's a decision worth discussing.
Yeah.
Maybe it's a good decision, but I'm just saying it's still a decision worth some discussion.
Indeed, and in fact, we talked about it when we did the domestic equity structure, maybe 2 meetings. We pointed out that you are overweight small cap relative to the broad market. And so we did talk about that recently in the domestic equity structure. So why are we? Well, just to refresh your memory, it's over the long run, we believe risk premiums will pay off. And small cap risk premium, you should get paid more money by investing in smaller companies that have a little bit more risk associated than big companies. Now, it hasn't happened in this NVIDIA craze market, but over the long run, we think you should be compensated for it. We also think you should be compensated for other risk factors. And it's just that nothing's kept up with the Magnificent Seven right now. So the way the world looks like right now, it's like those risk factors don't pay, but over the long run, we think they will.
Mr. Swoop?
What do you define as or think of as over the long run? 10 years, 15, 20?
It's a term of art more than science. But you would think over a 10-year time period it should have paid off. If you look at valuations right now, large cap versus small cap has never been greater. U.S. versus international has never been greater. So anytime you're in a situation like that, just got to be careful when you're reacting to this recent time period.
It's a question, Rick, or Greg. So what if it's estimated by Morningstar that 38% of the profits or sales of the S&P 500, the biggest companies in America, come from overseas sales? Is there any weighting that it would make sense for we were talking to U.S. investors, U.S.-based investors, we're U.S.-based investors because most people tend to have an overweight towards their home market. I mean, it's just, if you look at investors throughout the world, that's often the case, that people tend to overweight their own market. Canadians tend to overweight the Canadian market, Australians, the Australian market, American investors, the U.S. tend to overweight their investments in the U.S. market. But given the fact that the U.S. has so many very, very large companies and that have, at least at this point in time, a dominance in a number of industries, particularly technology, but others. And if it's accurate, the Morningstar says about 38% of the revenues come from overseas. Yeah. I mean, the Japanese could say the same thing with Toyota or some other companies on their market. What value is kind of a prudent valuation to say, okay, if a substantial share of these companies' revenues come from overseas, we are getting some diversification. Not saying it's the same thing as having foreign or overseas-based companies that we can invest in and others can invest in. But isn't it fair to say that there's some international diversification just by the very virtue that something like 38% of their revenues is coming from overseas?
Yeah, so U.S. companies have some economic diversification associated with them. because their revenues come from overseas. And some overseas companies have diversification because they get revenue from the United States. But there are different types of companies in different jurisdictions, right? Historically, we have overweighted U.S. relative to the broad market. So if you go back 10, 15 years ago, I think the ratio of U.S. to international is closer to 50-50. Because of U.S. dominance most recently, it's now a little closer to 60-40. You've always been about 60-40, if not 70-30. And in fact, this board took down your international equity exposure when you funded infrastructure a few years ago. So you already tilted that way, and it's worked out to your benefit. That decision that you made.
So answer to the question is there's some value in U.S. companies that have exposure overseas, but are you saying there's no value in that?
Of course, there's value.
Okay.
To Apple selling phones in China, right? Just as if you invest in a K-based company selling in the United States, there's value in both. Yes.
Okay. I'm just wondering if, for example, if that could be one reason why the state of Nevada only has 16% of their portfolio in international stocks, is because the bulk of the single largest investment they have is SP 500, and a significant share of their profits are from overseas. And maybe they've factored in a certain amount of diversification with the SP 500's revenue sources. Therefore, the internationally domiciled companies that are in their portfolio for internationally based companies doesn't need to be perfectly weighted.
Yeah. Yeah, I can't speak to Nevada's rationale. But a Vanguard investing John Bogle, capital market efficient investor, would say, if the markets are efficiently priced and you believe in index funds, that belief in itself would say that you should have whatever the market is internationally or in the United States, you should just match that. So to be philosophically consistent, you would have whatever the market is. Now they're choosing to not be consistent in that way, and I don't know why. But that would be the logic. Okay. So, talking about the managers. And so one of the big takeaways on slide 21 is we think your small and mid-cap managers have actually done okay. Right? If you look across the board, they've beaten their benchmarks. So we actually wouldn't recommend that you make a change to them. They've done their job. So on the next slide, on slide 22, we spent a lot of time talking about international or domestic equity. And you'll look at international, it's done okay. Last 3 years, it's lagging a little bit. Domestic fixed income has been your steady anchor, continuing to add value. Infrastructure's done great for you, especially relative to real estate. But where's your actual problem in the portfolio? It's your real estate manager. This has been the disappointment. This has been the headache. So this is where I think we should focus our attention. So for the last year, you'll see the real estate portfolio is down about 18%, and the benchmark's down 13%. So this is not a huge allocation for you. What is it, 11%? And over the long run, yeah, it's done okay. You know, it's given us 5 or 6% returns. But I think this is where our problem is. I think this is where we need to spend a little bit more time looking at your combination of your two core open-ended real estate management.
These are not liquid, or fairly liquid there. Take some time to get out, right?
Indeed.
So I have a focused in question at 625 Kings Court. Returns 8, 10, 11, almost 9, 6.5, negative 21, and then 0. How are we valuing that and getting like a minus 21 in 1 year and good returns in others?
We get an income and valuation return staff on Kings Court.
So there, and I'll look back over here. And so last year we didn't lose any income. We had a lot of maintenance, we had valuation down, appraisal.
Appraisal primary,
Yeah.
that was a large decrease from 1.7 million to 1.3. And the expenses have sort of crept up a little bit. We'll be able to see some of that behavior in a later item. And we can talk a little more in detail.
So there was
about
a 27% swing from 3 years to last year.
in 22, yeah, June of 22, the write down.
Thank you. Well, you can go back to the big picture.
Yeah.
Oh, I'm sorry, June of 23. June of 23.
So that's 0.2% of your total portfolio, too, right? So when we put numbers on a chart like this, just graphically, you think one is equal to the other in terms of contributing to your returns.
Right.
It's 0.2% of your total portfolio. Doesn't mean that we're not taking a close eye at it, right? Close look at it. But
We've had a lot of discussion about that one line item over the last 4 or 5 meetings.
Oh,
We're
okay.
not participating.
But for, oh, thank you.
Director Enchler.
That's
For
it.
comparison purposes, we wrote down our real estate value on the Kings Court building faster than the real estate funds that we hold revalued and wrote down portions of their portfolio.
Got it.
So we only have one property to deal with. They go through a process where they're valuing so much every quarter. So our write down showed up back further and isn't necessarily represented here. I just wanted to point out that there is some timing issues because they're larger and dealing certainly more complex portfolios than our one building.
And you might characterize these problems starting last year as a buggy whip issue. Like you don't need any offices anymore. You don't need a buggy whip anymore, kind of thing.
I'm not familiar with that term, Richard.
Yeah,
The buggy whip?
well, you wouldn't invest in a buggy whip company back in 1930 when they were value was going like this.
Yeah, right, exactly.
Okay.
That's been a huge issue in the real estate.
Sorry to use an ancient thing.
I appreciate it.
Are there any real estate portfolio managers that have done decently that you come to mind?
There are certainly other core open-ended real estate funds that have done better than bad. Have they produced a positive return? But one thing we want to be patient and careful about is we're going through a valuation cycle. So ironically, the manager that writes down their book the fastest is the one that looks the worst, but it might be the most true. So we want to be careful in how we look at this, knowing that bias. The kind of the consistent performance pattern of some of these managers is something that's still pretty concerning for us.
But if you cashed out of these, you'd cash out at what we're looking at in the red.
Yeah, indeed, and like you alluded to, Richard, these funds, you got to get in line to get your money out. So it's not like you can just sell it. And if we wanted to put it somewhere else, you need to get in line to put the money somewhere else too. So this is not like a stock portfolio, buy, sell, boom, boom. I think if we come back with a strategy, what we want to do is, okay, what do we want this portfolio to look like 3 years?
So in this area, both Dan and I have spoken about housing. Are there more investments in housing? I can't imagine that.
Richard, can you speak up? I'm sorry.
I have to lean into the microphone, I'm sorry. Anyway, housing is rather than more diversified property ownerships, but corporations out there trying to build and manage housing.
Yeah, so residential real estate, multifamily housing is actually held up pretty well in the market. Mm-hmm. And there are funds that would have a higher allocation to those. Some invest exclusively in that as well. So we can bring you some ideas about that and talk through some of those ideas.
Mr. Jardy?
So specific to page 22 that we're on, can you clarify, both under real estate and under infrastructure, there's a line that says NFI-ODCE equal weight. Is that an index fund that you're just sort of using as a benchmark for both the real estate and for the infrastructure fund?
Yeah, so naturally there's not an index fund for private real estate or private infrastructure. You can't just go out and buy all the estate out there. So what this index is it's the average open-ended, diversified real estate fund out there. So it's more like a peer group median than it is an index, if you will. So the NFI Odyssey, people call it the Odyssey Index. That's the open-ended core real estate funds. And we're saying, okay, what did the average one of those return?
Okay, so just while we're looking at page 22.
Yep.
That index, you show it going back 15 years under the real estate category, but for some reason under the infrastructure, it's only going back 7 years. But obviously that index, if it exists for 15 years, it exists for 15 years. It's just not showing those later years in the
I don't know why that didn't populate.
infrastructure category.
Yeah, we'll take a look. I mean, we could add it. Now, naturally, you didn't have the infrastructure back then, but we could just fill out that.
Yeah, apparently we didn't have infrastructure for 3 full years yet because it's not showing 3-year performance yet.
Yeah, that's right. That's right. You're 2 3/4 years for infrastructure now.
And so would it be reasonable for a pension fund like us or any investor if they were looking at rebalancing between real estate and something else, that one of the things that they would look at would be infrastructure as an alternative? I mean, presumably one of the reasons, I don't think I was on the board when real estate was added originally to the portfolio. So I was on the board when infrastructure was added.
Yep.
But presumably the original reason for adding real estate was to be a diversifier from publicly traded equities and or bonds. And I think that was part of our thinking with the infrastructure was rather than adding more to public equities, but something that was going to yield more than bonds. We were looking for something else, and infrastructure seemed of the choices out there. It seemed like the best of the choices for us. Anyway, I'm just wondering if it would be reasonable if we were looking at reducing our allocation to real estate over time, not in one fell swoop. If infrastructure, one of our 2 funds or both of our 2 infrastructure funds, might be a logical candidate for some of that rebalancing.
We took a look at your broad asset allocation mix a few meetings ago, and that's where we mentioned, the target to infrastructure, target to real estate. At a future asset allocation study, we can certainly look at changing the mix between real estate and infrastructure. I kind of have a feeling that this cycle will probably play out by the time you can get your money, right? If you get in a queue and you want your money back, it's probably going to be here, right? And the valuation cycle very well might
Trustee
go through
Harris?
by that.
I'm thinking back to when we added real estate, and at that time, real estate in California was doing exceptionally well, and we wanted a diversifier. And so I'm asking now, is there or are there any funds that are specifically focused on a state like California that's desperately in need of housing and has a lot of money tied up in office buildings with people who have changed from working in an office to working at home? So it seems that this, there's a lot of potential. Even in a town as small as Ukiah, I look around and there seem to be apartment buildings going up all over the place.
Yeah.
And folks from Santa Rosa who can't afford a house down there,
Yeah.
or even an apartment, are moving here and commuting. So it seems like a point in time, because any of this is just a point in time,
Yeah.
that this could be a potential area of investment by a funds manager or company, whatever. Just asking what
Yeah.
you think
Yeah.
of that, Greg.
Yeah, I think that's fair. And there are some funds out there that target California. They're less diversified. California is, there is an increased risk of being in only one geographic area, earthquakes, fires, concentrated employers. Way back in the day, you might remember when the government contractors for military. Remember that?
I do.
Right? I mean, that was really tough for especially Southern California at the time.
Mr. Reveles? You have something? No?
Okay.
I'm sorry.
Okay. So, maybe we'll flip ahead to slide 23. And here we're just going to look at pieces of your domestic equity portfolio. And Hannah, why don't you the next 3 slides?
Sure. So here we have the domestic equity portfolio. It returned almost 12% for the last quarter and 24% for the last year. It did trail the Russell 3000 index, which we spent a lot of time discussing today, is because it has an overweight to small cap relative to the Russell 3000. But over long-term periods, this has been beneficial for the last 7, 10, 15 years.
So what is this peer group?
This is for public funds domestic equity. So relative to your peers in domestic equity, have landed above median top quartile for the intermediate to longer term.
This is looking at other public funds and how they invested. So your ranking is actually.
Under the hood of the domestic equity, we have 25% of the 30% in the 35% in the passive S&P 500, but the other 10% is split between 5% mid-cap and 5% in small cap. So this looks at your 2 mid-cap managers, Fidelity Low Price Stock and Janus Enterprise, 1 value, 1 growth, in aggregate how they've outperformed the broad benchmark. For the last year, 3, 5, 7, 10-year periods, they've all outperformed the mid-cap index and ranked favorably versus other mid-cap mutual fund. Same is true for the small cap. So this is, again, 5% of your portfolio split between Prudential and AB in growth and value. But in aggregate, they've outperformed the broad small cap Russell 2000 index over the last year, 3, 5, 7, and 8.5 year period, ranking the top of the peer group for the longer term periods.
Okay, so in aggregate, your small and mid-cap managers are looking pretty good. Your domestic equities portfolio looks pretty good, especially relative to other public funds. And we're of the opinion that you don't need to make a change here. Now, having said that, when we met with you a few months ago, we talked about the domestic equity structure, and you said, oh, let's see what other options are out there. So at the board's direction, we've been conducting a search for small and mid-cap managers, SMID-cap managers, right? And one of the things we observed is, you know, once you start taking out one or two of these managers, just redo the whole structure, right? It's kind of like Robert and I have been talking about, it's kind of like a Jenga puzzle, right? You pull out two pieces and the whole thing falls down. So if you're going to start making changes, just rebuild the structure. So Robert came down and visited our office 2 times, and we walked through all the candidates out there in small and mid-cap managers at the board's direction, and we conducted a search, and we put a lot of work behind all of this. And on the next slide, 27, we identified these managers as potential replacements for your existing 4 managers. So we've got 3 categories, SMID core. So let's say you just wanted 3 core managers. You could interview and pick amongst these. You've got SMID growth and SMID value. And under that structure, you know, perhaps you'd have 1 core, 1 value, 1 growth. So we did all this work at the board's direction, and here are the funds that we think are good potential replacements. Now, again, we don't think you need to make a change. I think what you got is good, and the numbers kind of bear that out. But if you wanted to continue to march forward, the next step would be to start doing more diligence on these managers, and then also, you know, we would want to sit down with Robert and your staff to make sure we're all aligned on, you know, what we think the path forward would be with the SMID. Now, having said all that, we think what you have is fine, but here are the candidates that we identified in the search at your direction.
Trustee Swoop?
What time horizon were you looking at when you were doing this analysis?
So when we identify managers, we look at attributes about the firm, organization, and the team, characteristics of the portfolio, and we look at performance. And so it's kind of like all of those things, but from a performance standpoint, we try to identify consistency of returns, and we often look at rolling 3-year returns and cumulative 3, 5, 7-year returns. That's, you know, one metric we look at to screen the universe originally, rolling 3-year returns, 4, 5, 7. But it's not the only return numbers we look at, naturally. Did that answer your question?
Trustee Giardi?
So I've seen on Morningstar quite a few funds that focus on small cap or mid cap, but I haven't seen very many funds that are the SMID. So could you just tell us a little more about your understanding of the universe of SMID funds? I mean, when you say SMID, are all of these funds that you're looking at a blend of mid cap and small cap, or are some of these funds, I mean, these are managers. These are not funds that we're looking, because we're not seeing the name of the funds. We're just seeing the name of the managers here. So are you looking at funds by these managers that are both mid cap and small cap, or are some of these funds that you're looking at strictly small or strictly mid?
All of these managers are benchmarked to a SMID cap index. So something like the Russell 2500.
They're benchmarked, but is their portfolio that you're investing in a hybrid of mid and small, or if they choose, they could be offering just small or just mid cap companies, even if their benchmark is the SMID?
They can choose to differ from their benchmark. but they would be taking that risk, right? And you pay them to take that risk, and they all do differ from the benchmark. But all of these are benchmarked to the Russell 2500 or the Russell 2500 growth or the Russell 2500 value or something comparable to those indices. They are not benchmarked to the Russell 2000, and they're not benchmarked to the Russell Midcap Index. So maybe that's answering your question a little more.
Okay, so they can have any portfolio they want. They may say our fund is a growth fund, our fund is a value fund, our fund is a core, but they can have any composition they want. They could have it all. They could have very small of the smalls, or they could have, you know, almost entirely mid-cap if they wanted to, but they're benchmarking themselves against the Russell 2500, which includes mid-cap.
Yeah, so their North Star, I need to beat this index. It's the 2500, and they can choose to deviate from it, but they're not going to take ginormous bets relative to it.
Because I don't know all these. I mean, I recognize, I think, all the fund managers here, but I don't know all the funds that you're pegging these managers to. I do know that Dimensional Fund Advisors is well known specifically for kind of a science to some of their, you know, it's kind of a hybrid of indexing and actively managed, and in particular, they get often referenced in small cap value, and maybe being one of their more popular funds. So I'm just curious if that fund that you're looking at by Dimensional Funds is a small cap value fund, or if they have a fund that does reach into the mid cap that you're looking at.
No, it's benchmarked to the 2500 value.
I get what you're saying, it's benchmarked too, but whether or not the fund includes mid cap or not.
Yes, the managers have a whole span from the small to the mid that they can choose freely.
Okay.
Yeah.
And you happen to know that fund
Absolutely.
that they're looking
Yes.
at does include mid cap?
Absolutely.
Okay. I wasn't aware that they had a fund that, it seemed like, from what I understood, that they were marketing, hey, here's your small value, or here's your mid-cap value. I didn't know that they were also marketing, you can get both mid and small in a single fund.
We get some special deals. Because we got more money than your
Institutional
average,
advisor or investor, you're saying sometimes these companies will maybe blend two funds together.
Yeah. Now, all of these managers, they're in funds. They're either mutual funds or collective trusts that are exclusive to institutional investors. But I'm pretty sure PFA has a SMID value.
Okay. I think they're better known for more targeted, but maybe.
Yeah. Right. So maybe I'll just pause here. I mean, so we don't think, you know, it's good that we've done this work. We've got these mid-cap managers. I don't think you need to make a change now. In the future, if you decide to, you've got this list, and we could just dust it off and go forward. But for now, I'll defer to you all if you want to pursue this any further. If you want staff to spend the time digging into it and rolling forward with the mid-cap manager.
Trustee
Harris. So basically, you're saying we're doing pretty well, especially compared to our peers.
Yeah.
And if we wanted to make a change, we would have to stand in line to get out of what we have, and we would, excuse me,
For real
but
estate.
it would take time.
Yeah.
And then we would have to stand in line to get back into something else. And by then, the markets could have changed, and the people that we initially had and their funds could be the top earners, because they're very close to the top now. So it just doesn't seem to me that we need to do anything. The work that's been done, as you say, makes us all have more knowledge and hopefully be better board members and have more of an inkling as to what goes on. but as far as I'm concerned, I don't see a reason to try to make a change at this point.
Mr. Reveles?
So we don't want to get too far off the agenda topic here, but staff's plan was to bring back a final recommendation. This was merely an update on where we are and what we're thinking.
So I'm looking forward to the report. I think information is always good. You know, there's no way for me to know whether or not our current portfolio is better than than what we could get with these mutual funds. I would like to see what our options are. And I think if I understand it correctly, I think you were referring to to get out of our real estate, it would take some time, but actually these are publicly traded mutual funds or they're publicly traded equities. And so if at a board meeting we move to change, literally within 30 days, Robert and company could execute.
Yeah, I think that's fair. It takes a little time to contract with some and stuff like that.
I'm sorry, I was talking about getting out of real estate.
Yeah, that's right, Jerry.
So on the small and mid stuff, we've heard plenty from Dan about the work he's studied and all this. I wouldn't mind understanding Nevada and what that looks like. And if it's only to get us a piece of paper that comes out of a report like this that they get, and how that stacks up against what we do. I guess I could look this way, because that takes, not one of us should be telling you what to do or asking you to do.
Well, so you want to know how Nevada invests their equity portfolio? Is that what you're saying, Richard?
Well, yeah. I mean, if we have a comparison to make against what we have, what you guys have studied, and why can't this other comparison be brought into the picture?
I mean, we can naturally need to keep other clients confidential to the extent it's not public information.
Okay.
But we can share with you public information.
Well, right. I mean, all of this stuff we've got, everybody in the world can see. I imagine they have public meetings like we do. And
yeah, I just want to put that disclosure. Talk about other clients.
Is there any public comment?
There is no public comment.
Thank you.
But to me, your equity portfolio is doing pretty good. To me, the bigger priority is looking at real estate, right? That's not, this is working. Let's kind of spend some time also looking at real estate.
so to do that, then back to the concept of housing stuff, I mean, can we get a nod from everybody that, or a no that we would be interested in seeing more specialized real estate investment?
So actually, if I could ask a clarifying comment, is there consensus and direction from the board on whether to pursue anything further in this mid-cap arena, or do you want to leave our equity allocation and portfolio as it is?
Trustee Kelly?
I think we're spending a lot of time talking about individual managers in a particular piece of the portfolio to no real end, as you say. We seem to be doing pretty well in that category. The really big deal that keeps on coming up to my mind is that what we're really wanting to look at is the overall asset allocation. So, getting out of real estate is changing the asset allocation as opposed, and I'm still unclear on our board's capacity or when we make these big decisions about how much we want in real estate, how much we want in mid-cap and so forth. We've already made that decision about how much. The board made the decision some time ago, last 2 years, whatever it was.
We just did an asset allocation study, and adopted an asset allocation in February of this year, which was then changed, and this allocation was adopted in April of '23. I said this year because I didn't realize now it's 2024. So yes, February of '23, and then it was revisited and changed to the current allocation in April of '24. So we go through an asset liability study every 3 years, and we just did do last year an asset allocation study and selected this allocation with the allocations to real estate and domestic equities. There is, I guess, talk that we could potentially modify our real estate allocation, but that would take time. But I think it might still remain that we would have the same percentage allocated. It might be a change in manager.
So there really are two separate questions here: the specific asset allocation to real estate, and then if we're not getting out of real estate, then what kind of real estate should we be in?
Right. We started the big picture, which was selection of an overall asset allocation, and then it goes down to review of the individual components like equities or fixed income or real estate, which would then go to manager selection. So we've done sort of the equity review, and when it comes to the real estate review, we could look at not changing the overall allocation to real estate, but changing perhaps the allocation shift between the funds we have with real estate and infrastructure, maybe more to infrastructure, or maybe more to a particular segment of real estate like housing. But those then are the second tier, and then you go down to the third tier, which is manager selection. When we were doing the portfolio review for the equity structure, there was discussion about our small and mid-cap allocations, and that's why we were discussing the SMID arena. And the question, I think, for the board today is whether they want us to move forward with looking at individual managers and bringing managers in for interviews with the intention of moving from a small and mid allocation to a SMID allocation, because board needs to provide that direction to staff so we know what to bring back to you in the next month or two.
May I step in for a moment?
Certainly.
So while the board certainly has flexibility when it's discussing investment matters, I mean, that's one of your most important fiduciary duties. The agenda item that we're on right now is entitled Quarterly Investment Performance Report Summary. So my understanding, and please correct me if I'm wrong, was that some months ago there was direction given to staff to look at these mid-cap managers, and I thought that this was simply a slide to tee that up to bring it back another time. So I think you have some flexibility, and perhaps I'm not understanding the issue, but I think we do need to be mindful of where we are within the agenda.
I thought the agenda had been changed to include an update on the SMID, but that's not actually on the agenda language, so I apologize.
No. Council is correct. Staff's intent was to bring back a recommendation next month on SMID. We've sort of kind of veered off a little bit, getting distracted by the real estate performance and the situation within the real estate market. We want to step back to, we're looking at structure review. So we certainly can jump into real estate structure review after next month, but we wouldn't necessarily be talking about restructuring the amount of money invested in real estate and infrastructure. That was a discussion that we resolved last year.
Okay. So it sounds like next month, come back with a formal recommendation, what to do. I'll admit. Sounds good. We've taken up a healthy amount of time. And I know you have other agenda topics, I'm sure, but we were going to walk through the performance report just to let you know it exists. Some of the stuff in there. We can do that at a future meeting, future time, or we could dedicate time to it. So I'll kind of defer. We could do it next month when you're talking about mid-cap managers too. So.
What is the pleasure of the board on that? Thumbs up for next month, or? I don't know. Okay. Well, I didn't get a lot of thumbs up.
Here's one.
Oh, yeah.
Yes.
Yeah, next month.
At what everybody.
Yeah. So can we do that one more time, because I didn't see a lot of thumbs.
Yes. We have an ETA meeting.
I'm sorry, I didn't hear.
I'm sorry, I can't
Hear you.
You're asking if we have an ETA for the end of the meeting? We do not. We have a closed session that we will go into. I'm hoping that it won't be a particularly long closed session, but I never know. So we have to get through the rest of the agenda, and we have closed session.
The conference room,
How much time would?
You know, Richard, I talk a lot. 15, 20 minutes.
we should try to be done by 1 p.m.
Rest of the items on.
I don't think anything else on the agenda would take particularly long before we get to closed session.
I would wrap up.
Always.
what I wanted to do today. Everything
I'll refrain from a bunch of questions, if that'll make it faster.
quick.
And this part, really, I think the board had, at the previous meeting expressed that they kind of wanted more information about the specifics on how you look at the manager, the detail there as far as what attributes you're looking at. Is that right, Robert? So maybe we can just touch on a few of those.
Okay, so we have a different attachment. It's called MSRA 4Q23 Performance Report. PDF.
Got it.
And unfortunately, it's in portrait. So it's a little harder to see on screen. And that one's the monthly. Yeah, you want the huge one. I'll just kind of, so we have the table of contents, right? Then we talk about the capital markets, but maybe we could just flip ahead to I think that's a great call. If you don't mind, let's flip back to 6. And there we go. So, yeah. So this is your total domestic equity portfolio. And we already looked at the top chart, right? And that shows your peer group ranking and your performance relative to the index. The bottom left-hand chart here shows your quarterly performance relative to the index, the bottom left-hand chart. Then the right shows risk and return, standard deviation and return, annualized return. And all the little dots there, those are all your peers. Those are the public fund domestic equity peers. On the next slide, next page, on the bottom, we look at calendar year returns. And then on the bottom, we start getting into CAPM sort of metrics. Alpha, Sharpe ratio, and excess return ratio. And keep in mind, this is over a specific time period. This happens to be looking at 5 years. So it's looking at alpha, which is a regression measure.
Page 30.
Sharpe ratio, which is return per unit of risk. And excess return ratio, which is how much you outperformed the index divided by tracking error. So there's a bunch of data in these charts, and we go through and we look at every one. But what I think is kind of interesting is on the next slide, we actually take all the funds you invest in, get all the holdings in all of those funds, and we put them all together. We say, okay, so what's your underlying exposure in the equity market? And on the top, we can look at some big picture characteristics. So we call these characteristics. Sometimes you look at returns. Sometimes you look at characteristics. Characteristics are, okay, what do I hold? What am I exposed to? And so you see here we've got the weighted median market cap. So your portfolio's weighted median market cap is 82 billion. Go out and you look at the average company you hold, it has a market cap of 82 billion. And the Russell 3000s is bigger, 142 billion. We've been talking about this the whole time, right? You've got a little bit more small cap than large cap in the portfolio. And then we have valuation metrics after that. Price forward earnings, price to book. So how much are you paying for each unit of earnings or book value? That's what those numbers mean. Some people call the PE, some market multiple. Some people use that term. It's price forecasted earnings. So this is how much money you spend for 1 year's forward in earnings. So what do those numbers say? So 18 is your portfolio. So you're paying $18 for each unit of earnings, and the index is about $20. Your portfolio on average is a little less expensive than broad index. Okay? But it can't be a free lunch, right? Let's look at the forecasted earnings growth. 2 lines over. This is the average growth rate of all the companies that you hold over the next year. Their earnings is forecasted to expand. It's 14%. So pretty good, right? But the Russell 3000 index is a little bit higher. You're not paying as much, but your growth rate is, for the average company out here, is a little less. So what that means is you're underweight some mega cap growth companies that have some forecasted earnings growth rate. NVIDIA. What's NVIDIA's forecasted growth? Right. Huge, right? But that's the difference there. Then we've got dividend yield. So this is how much you take the dividend and you divide it by the price of the stock. You get dividend yield. Dividend yield for the U.S. stock market is only about 1.5 right now. The amount of dividend you get for each dollar you invest isn't huge, 1.5%. And then we get to a really geeky number. It's called MSCI Z-score. And what this number tries to do is tries to capture the valueness and growthness of the portfolio in aggregate. Right? Do I have an unintended bet in here? Do I have a big bet, growth versus value in here? And you see the MSCI Z-score is -0.1, and that's really close to the index. This is a standard deviation sort of number. So 1 would be a pretty big number. 1.5 would be a pretty big number. 2, and you're 0.1. So really close. On the bottom of the page here, we show your sector allocations. So how much do you have allocated to information technology, financials, healthcare, et cetera? And you are the blue bars, and the green is the index. And then the yellow is the average public fund out there. So there are a little bit of deviations here or there, but in the grand scheme of things, all these bars look a lot more similar than different from each other, right? And it's because you've got 25% of your fund invested in a S&P 500 index fund, right? That's going to be a big anchor for you to make your portfolio look like the broad market in average. And over on the right, we have the number of securities in your portfolio. So you have exposure to 1,600 securities in your equity, U.S. equity portfolio, a lot of securities. And then issuer diversification. This says, well, how many securities do you need to hold to get to half of your portfolio weight? 99. So about 100. The Russell 3000 is 55. So you are more diversified Russell 3000 index. It takes you 99 securities to get to half the portfolio. The Russell 3000, it takes 55 securities. Portfolio. Okay, so that's the broad equity portfolio. And the next slide here, we look at a style map, and it's really relying on those Z-scores. You'll see that on the bottom. The Z-scores are really driving where these things plot. And you got your small cap value manager on the bottom left, your small cap growth manager bottom right, and then your two mid cap managers, Fidelity, Janus. Not as big of a style tilt for both of them, but they balance each other pretty well. Then you've got the S&P 500, has a larger cap than the Russell 3. We know that. And then the whole thing, you wind it all up together, you have the domestic equity composite. You see that's really close to the middle line, really close to core. We don't want to make an unintended bet here. And you're a little smaller than the Russell 3. But, you know, still pretty darn close to it. Okay, so this is a big picture style map. Now, importantly, these style maps are not driven by regression. They're driven by portfolio holdings. So sometimes you look at other data providers. They might be regression-based. That means, do the returns look like the returns of another index? All right, well, there could be spurious data and correlation in there, right? So don't over-rely on that. This is looking at, well, what do I actually hold, right? So we think this is a much better analysis. Okay. And then we go into all the other portfolios, equity portfolios, and we go through that same thing for each of your managers. So you can go through and take a look at that at your leisure. Maybe we flip ahead. So the PDF on the bottom right-hand chart, Judy, it says 48, or you could put in 51. Put in 51. So we just wanted to show you, okay, what do we look at for, so we do the same stuff for international equity, but international equity, you also have region and country. So the bottom right here shows what's our regional exposure for the total international equity portfolio. Okay? And at the top, we've got Europe, essentially, and the Middle East. They kind of put them together. Europe far dominates by market value. You're the blue, 54%. The ACWI XUS, the green, that's your benchmark. If you invested in an index fund, you would be green, right? But you've got your active managers, you're blue. And you'll see that you've got a little bit more in Europe, a little bit less in emerging markets, a little bit less in Pacific Basin, and a little bit less in North America. So North America, that's Canada, right? That's not us, right? No, that's in emerging markets. They put that in there. But Canada, people often forget Canada. There's another index out there. It's called the IFA index. That actually excludes Canada. I don't know why. But a bunch of funds are benchmarked to IFA. They don't have Canada in the benchmark. But this other thing that we use, MSCI ACWI XUS index, that includes Canada. Okay, so this is your international equity portfolio. By region, on the next slide, we actually show it by all the countries. And so what we do is all the funds you invest in, we collect all their holdings, and then we map it over, and if we can identify the security, we put it in the country. It's a ton of work, it's a ton of data. And the blue here is the international equity composite, and the green is that index. Okay, so you notice the UK here is kind of a bit of a deviation. You've got a meaningful overweight to the UK. That's Marathon, your active international equity. It's got a big overweight. Then most of the other bars are, more similar than different from each other. But you have all this data in here if you have a question about your international equity composite, but then we also have this information for your managers as well. Maybe we'll flip down to the bond managers.
So before we leave that,
Yeah.
on what page would we see our performance of our international equities as a group, as opposed to the individual funds?
So that's, you could go to 49. So this is the international equity composite versus the index and the
So where's the time period? You're on, you said you're on page 49?
a PDF 49.
Oh.
Oh, yeah, 50. The bottom right-hand chart is 52.
No.
Oh, 46.
They were on the correct. Yes.
Yeah. Yeah, there you go. And that's the same chart that we put in your summary presentation as well.
Okay, so just for clarification, so last 15 years, our international composite of the funds we chose to invest in earned, if I'm reading this correctly, annualized rate of return 7.32?
Correct.
Okay. And the benchmark for international would have been 6.93. So we had a, 40 basis point, 39 basis point bump.
Well, that's the EFI, so you might use the MSCI ACWI EXUS, the 645.
Oh, 6.45. Okay, got it. So
That's correct.
the benchmark was 6.45 and we achieved 7.32. Okay.
And that's a good number, Dan, but honestly, this international equity combined portfolio is the one that we worked on a lot over the years. So fixed income starts on 79, so if you put in your number, 79, yep. And so here's your fixed income composite. Got the relative returns. Bottom left-hand chart here, just one thing I want to point out. You've had one big drawdown relative to the index here, and that was the beginning of COVID. So the one thing about active managers and fixed income is they tend to underperform in flights quality and when liquidity goes down. That's really what happened in the first quarter of 20 when we went into the COVID scare, beginning of the whole COVID cycle. But since then, you just got to stay patient in those time periods because the yields gap out and then they come back in, right? And then we've been able to clip a alpha coupon from these managers for the last several years. Now, the bottom left-hand chart shows relative returns. The top chart shows absolute returns, right? And 2022 was a historically difficult year for fixed income. If we flip ahead to a few slides to 81 here, Judy, here's where we start looking at your total fixed income composites characteristics. So duration is the number one risk in fixed income. How much interest rate risk? So the way you think about this, okay, the fixed income composites duration is 5.8. What that means is if overnight yields went up 1% across the curve, overnight, boom, your portfolio would go down 5.8% in value. Okay? That is the risk associated with bonds, interest rate risk. How sensitive are your bonds to changes in interest rates? What that doesn't tell you is, well, what's the yield? But we have the effective yield over here. Your yield of your portfolio is 5.3. So even if interest rates went up 1%, you lost 5%. If you held it for a year, I know you're going to make back that 5.3, and in fact 1% more because interest rates went up 1%. You'd make back 6.3% over the next year in yield, just yield coming into the portfolio. So duration, effective yield, the coupon rate and average life, those are interesting statistics, but a little less intuitive, and they're really wrapped up into duration and yield, which are more important. And then convexity shares with you how much your duration changes if interest rates change. Derivative number. The bottom chart, this is, what kind of bonds do I hold? Okay. There are different types of bonds out there. RMBS, that's residential mortgage-backed securities. Ginnie, Fannie, Freddie sort of backed mortgage bonds. So when you and I borrow money to buy a house, that's securitized, and then it's sold to the market. So our mortgages wind up in a portfolio like this. And so that's what RMBS is. Then we have corporate bonds, U.S. Treasuries. You see the managers are big underweight to U.S. Treasuries. Government related. What is that? So government related would be like agencies. Fannie and Freddie need money to do what they do. Can also be Mexico. Mexico is actually in the index, China. They're investment grade, they issue over 250 million, and they're US dollar denominated, and they're issued in the United States. They're in the index. And then there are other types of securities, non-agency mortgages, CMOs, asset backs. Asset back, you make an auto loan, you borrow money to buy a car. That's in here, right? And then CMBS, that's commercial mortgage-backed securities. So there's a lot of talk about this area right now. Who lent money to buy a commercial property in downtown San Francisco and collateralized it, sold it? And what's going to happen when those loans reprice? And then on the right here, you have the weighted average quality of the total portfolio. You take all your bonds, and you have a weighted average quality of AA minus. I have a trick question for you. What is the credit rating of the United States? The highest rating is AAA. The lowest rating is D. We are not. We are AA. U.S. Treasury was downgraded by 2 of the 3 major rating agencies over the past few years. And it's because we can't pass a budget. It's because of congressional dysfunction. The credit rating agencies come out and say it. And by the way, it's the sustainability of our debt going forward. And for that reason, the credit agencies say, I don't know. Are you AAA anymore? So the U.S. lost it. Lost our AAA rating, which is kind of sad.
What is AAA? Recon?
Who is AAA? I'll get back to you on that. But who's a better credit than the U.S.? I'll get back to you on it. But
Yeah, you buy.
you got it, Jeff?
Well, I can't say that I knew it without my phone.
Yeah.
Australia, Canada, Denmark, Germany, Luxembourg, Switzerland, Netherlands, Norway, Singapore, and Sweden.
It's good to phone a friend. All right. So that's some of the characteristics we have, and I think that's kind of a good summary of some of the information we have in the book. So there's more information in there. Feel free to thumb through. If you ever have questions about it, be glad to address it and coming up at a future meeting.
There is no public comment at this time.
Thank you. Thank you.
All right, good to see you all. Thank you so much. Yeah. Okay.
Your drive back?
Thank you. Thank you. A little foggy.
Okay. Next agenda item is the preliminary monthly investment performance report. Mr. Revels.
Trustees, you have the monthly performance report. I'd be happy to answer any questions. It's mainly informational.
Seeing none. Next, fourth quarter real estate update, Mr. Revels.
Trustees, we have a graphical version of the same type of information that we looked at last month on the real estate characteristics. Can I share my screen here? Tab. Sorry about that. There we go. Yeah, okay. Real estate characteristics. These are the same sort of data points that we looked at last month. They're just in graphical form for both managers and updated through December of this year. So here we've got Barings region, Barings sector, and we can see that the comment that Greg made about wanting to be on the west, we can sort of see that drift here since the start of 2018. On the left-hand side, the western line has started a little under 40% and gone up to north of 45%. And of course, we can see similar declines in the other regions here. Barings has exited the Rust Belt. On the sector exposure, we can see office has really moved around quite a bit. It was previous to COVID around 30% on average and has since gone down. That's been through sales that they've done. And here we can see that industrial has really moved up. This has sort of been the hot sector in real estate over the last few years, and we can see that Barings has increased that exposure markedly over the last few. REEF, we can look at the same information. REEF has probably had less changes in terms of their regional exposure, and their sector exposure sort of shows the same sort of behavior where we see office trailing off, again through sales, and folks wanting to not be exposed to that part of the market. And the REEF industrial has gone up. And the REEF has a large portion of the fund in industrial. Those are like warehouses, incredibly stable and generally good income for long periods of time. The next page here, occupancy rates. This was really the graphics that I was thinking about. I was recalling Trustee Shoemaker making a comment about the table and wouldn't it be better to see those occupancy rates over time instead of the table. So I just dumped these into graphs so we can look at that. You can sort of see the same sort of behavior for your office. Office appears to be much more volatile in terms of occupancy for both REEF and Barings. And the large drop off here with REEF in COVID is sort of what we expect to see, unfortunately. The other occupancies have remained relatively stable over time. Here we look at the income and appreciation returns. There's different sized graphs here on the right-hand side. I just kind of want to point that out. I put them on separate charts because it's hard to see these small fluctuations in income when you're looking at a chart with this appreciation. But here you can really see the impact of work from home and rising interest rates on the appreciation. We've got the peak close to the end of 2021, and then this sort of steady decline in both the NFI Odyssey, the benchmark, and Barings and Reef individual. So here we can see a few interesting things if we look sort of close. That Barings curve here is starting to curve down sooner than Reef or the NFI Odyssey. And then we can also see this sharp drop here recently, and that's been a large drop. Barings now has 4 office buildings, and they've written those office buildings down to the value of their outstanding debt on the building. There's almost nowhere, I shouldn't say it, but there's almost nowhere lower to go on those buildings. Next page, we show the gross returns, income and appreciation returns in a table format. These are gross returns, so these are not going to match the returns in the Callan report. Callan report's net of fees. But these here, I think they're just good to be aware of. Personally, I want to know the gross returns. We do pay, 85 to 95 basis points per manager for both of these, for our fees. We don't directly pay them. We pay them with sales of unit interest in the fund. And they also don't add up. If you add income and appreciation together, they may or may not add up to the total column. And the reason for that is because of the time weighting return nature of the total return. Finally, we have one new real estate investment term here on the last slide, cap rate. This is one of the most fundamental metrics when you're looking at real estate. It's the ratio of net operating income to market value. I show the formula for the calculation on the left-hand side, and on the right-hand side, I've got a graph here. Trustees may be aware that real estate loan interest rates are highly tied. They're very closely tied to the 10-year Treasury yield. And so what I've done here is graph the 10-year Treasury yield going back to 1993 and shown the NCREIF. This is the same company that produces the NFI Odyssey Index, the NCREIF transactional cap rate over this period. So these are the cap rates for actual sales as opposed to appraisals. You can appraise something, it can be higher than what you actually, close the deal for. And so we've got both of those graphed for this period. And then at the very top of this, we've got the King's Court cap rate. Again, that's our net income. You see that report every month on our real estate operating net income statement. And we track the value of the property over time as we have adjusted it to market value. And so if you look at this, you can sort of see that it sort of used to be the King's Court cap rate. The cap rate is sort of like the dividend yield for real estate. So we can see that it started up high, 10%-ish, and it's slowly gone down. I've added these trend lines here just to sort of help you see the slope of those lines. Those are the rates of change. And so we can see that it's gone from somewhere around close to 10%, just under 10%, to 5%. And as of today, with the decrease in real estate property value, the appraised value, that has sort of kicked up our cap rate on the property. this is a good slide because in closed session, we're going to look at some of these numbers more. Any thoughts, questions, comments? That's the end.
Okay. Next, we're moving on to discussion and possible action regarding code of conduct policy.
Chair Kavnes,
Yes,
could we take a break?
absolutely. How about, let's see, 10:40, 10. Oh, that's 10 to? What's your pleasure? About,
Shall we be back at 10:45?
okay. Settled. That's all right. I was going to give you credit. There's not a hurry.
Well, I'm on the coast. Wednesday,
You have a slide for that.
You did something.
Yeah. This slide here actually shows that sort of behavior. So they all started in place in 2019 before COVID. That into 2020. But as we move into 21, see, this is the well, housing is definitely a big driver. Medical cost has, there's another.
That's right,
Well, because last year. Yeah, but yeah, you're capped at the 3%. So, for instance, 22. Well, it's only lower since 7, right? Assuming assuming they're the same. Right, so that's it remains the same that CPI in the Bay Area is higher than both California and it remains the same that the CPI since 2000, the Bay Area is still higher, but just since 2017 has that rate flipped. It's about $4 difference on $100.
My watch.
Correct answer. Correct answer. Analyst.
Yeah.
And fellas.
Yeah. No doubt. I'm what?
Stand up in the middle of something like that.
Grateful.
Say you're sorry.
That very
I don't
only.
really difficult for me. Get a grasp of a pad on my computer is.
Knowledge.
Yeah.
Small portion. Maybe actually do a bond. Anyway. So, but so,
And you're at Coastal?
Redwood
Is that?
Coast Regional Center,
Okay.
which carries out Department of Developmental Facility. So by that, qualify for Alpha. Therefore. And
The one they could have done is traveling.
Okay. Oh, so you've been there a while now.
well, as
Been a month and a half tooling around Argentina and Chile. Yeah, Allison, the teacher, took a year off. She was home for a week and she's now in New Zealand till May. And she just bought a minivan that's outfitted like a camper RV. She's quite the independent traveler.
Does she want to move to
social security.
I don't know.
I think if she's traveling.
She's gonna come back and go back to work.
So, fine. Not a double dip. Double scooper.
Mini scoops, yeah.
That the cap rate was stronger.
Does he want to speak first? Cola. Okay. Okay. Thank you.
So,
Thank you.
buried in numbers.
Yeah, big time.
Okay, we're back in session, and we're going to take agenda item 5 first before agenda item 4, discussion and possible action regarding code of conduct policy. Discussion and possible action regarding approval of cost of living adjustment, COLA, as of April 1st, 2024. Executive Director Ridgler.
Thank you, Chair Cavness. We have the letter from Siegel, our actuary, with the calculation of the COLA to be applied on April 1st, 2024. The change in CPI was 3.6%, which is rounded down to the nearest half, rounded to the nearest half, which in this case went down to 3.5. Since statutorily we cap it, granting a 3% COLA, 5% or 0.5% will go to the bank. So if you have any questions regarding that, I'd be happy to answer any questions.
Is there any public comment? Oh,
Yeah, what happens with the bank?
The bank is used to provide up to the statutory maximum COLA in years where the change in CPI was not enough to grant the full statutory COLA. So let's say next year's CPI is 2%, but our statutory maximum is 3%. We'll use what people have available in their bank to grant the full 3%. So a new retiree may only get the 2%, but people who have something in their bank might get 2.5% or 3%, depending on the level of funds in their bank.
Okay, so it's something that each retiree would have. They have their own banks.
Yeah, by
over the length
year of retirement, and that is actually the second page of the Siegel letter, shows the cumulative banks by year of retirement.
Thank you.
Somebody retired in 71 is 7.5. Earth next year, that number.
For someone who retired in 1971, their COLA bank was currently 57, and when we add the 0.5% to it, it's going to go up to 57.5%. So even if there was no change in CPI and we had like 0%, we could be granting 3% cost of livings for people who retired on or before 1971 for many, many years. They're likely not going to use down their bank by the time they stop receiving benefits.
There's no cashing out of the bank.
No, this is not a benefit that is converted to cash other than granting the maximum statutory COLA in years where the change in CPI didn't allow us to do.
Any other discussion? Is there public comment? Mr. Almeida?
Good morning, Board. I come once a year. My name's John Almeida. I'm a Mendocino County retiree. And I don't see too many retirees here today, so I'll be the representative for these retirees. We thank you very much for the work that you do. I see there's 3 new trustees on the board. It is very important. While we don't all come here, we do watch your meetings on internet. The COLA raises are something that we paid for separately from our retirement. They were a different deduction for the legacy members. They're very important in this day and age. Just last week, I received a new raise in my electric bill of 21%. After the COLA raise last year was about a month later, and I received a 50% raise in my home insurance. So while it doesn't keep up with the cost of living, it's very important to us. It's very important to me. I want to thank each and every one of you on the board that you realize this and that you understand that how important it is. When I was working, I paid into Social Security and Medicare, and I paid a deduction for the county's retirement, and then I paid another deduction for COLA raises. And it was pretty overwhelming to pay the rest of your bills after those. There wasn't any money to invest in anything else. So now that I am retired and I'm receiving this benefit, I want to thank you for managing this fund, keeping it alive. We depend on it. Like I said last year, my father worked until he died because he couldn't live on Social Security. It didn't make up the amount that he had to pay his bills. So for a county employee to have this retirement, it's super important to us. So again, I want to thank you, and I appreciate the work that you do. It's hard work, as I've watched here when Callan comes up here. It is a very diverse project to work on, and it is very important, and it takes a lot of thought. And I appreciate Mr. Jurdy and his questioning this morning and the importance that we keep this fund going in the right direction. Thank you.
Thank you very much, Mr. Almeida. Okay, moving on to agenda item 4, discussion
Did we need a motion to approve?
Yeah, we need a motion to approve it.
on, okay.
I'd move approval of the
Second.
Okay, roll call vote.
Mr. Land?
Aye.
Ms. Cavanagh?
Aye.
Mr. Kelly?
Aye.
Mr. Jurdy?
Yes.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Okay. Okay. It keeps track. Where did 4? We skipped 4 because. Oh. Discussion and possible action regarding code of conduct policy. Director Rentschler.
Thank you, Chair Cavanagh. Council Burke mentioned at last month's meeting the potential for bringing a board code of conduct policy. The draft is provided for you, and Jeff or I are available for comments or questions if you have any.
Just a question. Did something prompt the drafting of this document?
Well, on last month's agenda, we had the harassment training, and I prefaced the discussion by talking about some incidents that happened in the town of Windsor, and just raised the issue with the board and got some thumbs up that about having a policy like this, and I thought the direction was to bring it back.
Motion.
This would be an opportunity for trustees to provide any direction if they want to modify the policy, and we could bring it back or to adopt it with changes or adopt as presented. Or I guess not adopt at all if that was the board's pleasure.
Any discussion? Trustee Harris?
I think we need one of these. My daughter is from Windsor, and she was asked recently to run for the town council. I don't think she's going to do it, but those of us, and I think probably everybody around this table, followed what happened in the Press Democrat. And no, we don't have anybody at this point who I think will follow suit, but it's nice to know we have a code of conduct. And this may not be, it may change over time, but particularly for new board members, it would be nice to have it included in our the manual.
New trustee orientation handbook, yeah.
So I would like to move that we adopt this code of conduct as presented, and then if there is a second, if there's a need for further discussion by board members to change it, maybe we could do that as well. So,
is there a second?
I'll second it.
Is there any discussion on the motion? Judy, could you take a roll call vote?
Yes, Mr. Land?
Aye.
Ms. Cavanagh?
Aye.
Mr. Kelly?
Aye.
Mr. Jurdy?
Yes.
Mr. Shoemaker?
Aye.
Ms. Harris?
aye.
Approved.
Okay. Agenda item number 6, discussion and possible action regarding Consumer Price Index Region Analysis, Executive Director Rentschler or Mr. Riveles?
I'll turn this over to Mr. Riveles.
Trustees, let me share my screen. I can briefly outline the memo for us, unless any trustees had any off-the-top questions or thoughts on it.
Actually, I will jump in here with a comment because several of the trustees are new and weren't here 5 years ago. Back in 2016, there was discussion with the board of changing the CPI index used for determination of the COLA here. In 2018, there was direction to bring this back in 5 years, which is why it's being brought back now.
I would say it's a remarkably comprehensive report. Thank you, Robert, for all the information, probably more than we wanted. My general take on it is probably the real estate market in the greater West, outside of the urbanized areas of the Bay Area, LA, et cetera, have finally really taken off. And that's probably why the greater Western region is now seeing the same or greater CPI as you were seeing historically in the Bay Area and Los Angeles.
So if we had chosen a different model over the last 5 years, would there have been any difference in any of the COLAs that were granted?
Yeah, there would have been a difference. There's about a $4 difference since 2017 for every $100 between the Bay and the West. Mm-hmm. Yeah, so, you know, the COLA in 22 was a 7% COLA. We grant the 3% COLA, but some goes into the bank. That 7 number would have been like 5.5, for example. So it would have been a little lower. The banks would be a little lower.
Yeah.
The bank. Yeah. No.
I guess if we had a situation where it was right on the cusp there, we would either be depleting people's bank or people who are newer would not be receiving as much, a full 3% COLA if we were in a different model in that case. Am I understanding that correctly? For instance, if we had the method.
I believe in all of the years of the past years that wouldn't have actually changed the amount we granted. It could have affected the amount that would have gone into the bank. Is that your question?
Yeah, my question was hypothetically, if we were right on a straddler there, we could have a situation where some people wouldn't get a full 3, newer, perhaps people who didn't have anything in the bank. Just a comment, I suppose.
Everybody since 2017, I believe, would have gotten that 3%.
Right.
It's just these little, nobody's drained the bank. Nobody's had to drain the bank. So I think the answer to your question is no.
My question was if there was a hypothetical situation. So there is no yes or no answer. Hypothetically, if there had been, but we haven't encountered that situation. So
we haven't.
Yeah.
And so broadly and briefly, I can go through this. We look at the so MSERA has to grant a COLA based on this statute 31870.1. What region of the BLS calculated CPIs do you use? And so we've got 4 different regions that we can use. Since we're not in a major metropolitan area where the BLS is creating one of these CPIs, we get to choose, do we want to use a metropolitan area close to us? Do we want to use the California CPI? Do we want to use the Pacific sub-region CPI by BLS, or do we want to use the Western region for those increases? And so this analysis really looks at all 4 of those regions and compares for each of those regions the Zillow Housing Index and the HUD fair market rents to decide which one of those regions most closely matches the Zillow Housing Index in Mendocino County or the fair market housing in rents in Mendocino County. So here we can see the regions in the Bay Area that are included. The dark green, or the dark shaded here are the Bay Area regions. The lighter shaded regions are the counties from the previous analysis that were included. There was a change in 2017 where these lighter shaded counties were stripped out of BLS's regional CPI for the Bay Area. The California CPI region is created by the Department of Industrial Relations, but it uses CPI data for the shaded regions here. Those numbers are calculated by the BLS, and that's a population-weighted total for each of the regions. And that's how the California CPI comes up with its CPI. This is the CPI that we use for rental increases for the building and the lease with the state. Figure 3 here shows the Western region and the Pacific subregion. The Pacific subregion includes Washington, Oregon, California, Hawaii, and Alaska. The Mountain subregion includes the lighter shaded states there, but the Western region includes all of them: Montana, Wyoming, Idaho, Nevada, Utah, Colorado, Arizona, and New Mexico. These are all combined together in the Western region.
Hey, Robert, before you leave that slide, isn't it true, though, that when you look at the Western region, all those states are included, but the federal government only data mines for certain metropolitan areas? So, like, just going to toss out, Las Vegas might be on the list,
Sure,
but nothing else in Nevada is. Or maybe Salt Lake City is they're getting data for Salt Lake City, but nothing else in Utah. And they may be getting nothing from Wyoming because there's just not a metropolitan area that they want to even sample. So isn't it true that although all those states are included, they're only data mining from a very Spartan number of metropolitan areas that don't even include all those states?
Sure. Well, I believe every state is included. It's just not every single town.
Okay. I guess from a previous presentation, I thought that Boise, Idaho was not, and there wasn't anything in Idaho, Montana, or Wyoming, but they were lumped in there.
Yeah, I would doubt that. I could follow up on that. On this slide here, we compare, okay, if we can use these 4 regions, what do the CPIs really look like for the time period that we're going to investigate? The time period we're looking at here is 2023. This shows the CPI for all these 3 regions really indexed back to 82, 84. I've just sort of cut off the graph so we have a shorter time period here to look at. But this includes the Bay Area, the West, and California. The reason that Pacific's not included here is because Pacific was indexed to 100 in 2017. So if we were to drop that onto this graph, it really changes the scale, and it is very difficult to visually see any sort of changes. It's essentially worthless to look at because the scales are so different. That's the reason why on this next slide I show including the Pacific region since the Pacific region's inception. So this is a graph of the CPIs for each region indexed to 100 in 2017. And from here we can see that for a few years the Bay Area had the highest CPI. That's this sandy brown line up at the top here. But once we get into the COVID era in 2021, the other regions' CPIs increase, and as of today, on a 2017 basis, those CPI rates are higher than the Bay Area. So there was a little bit of confusion at the time, some criticism, people saying, well, you're going to make this change and then we're going to have lower lower increases, even though the COLA increases are based on our assumptions. They're not based on the CPI. The bank is most certainly based on the CPI. In this instance, the banks have been greater since 2017 than they would have otherwise been if we had stayed in the Bay Area. These are more graphs just to sort of show shorter term year-over-year rate changes, and we can see that on the top graph here, these are all sort of following similar paths. And in 2017, we have the inclusion of the Pacific region here. It's a little hard to see. They're close. They're relatively close. The outlier year over year here, to my eye, is the Bay Area. We can see a little bit easier the Bay Area line. The other lines kind of go a little bit closer together. These second graphs just break down for the Bay Area and the West. I didn't endeavor to break down the California CPI for this particular graph to look over the period 2000 to 2023. I theoretically could have done that. It would have taken quite a bit more work to do that, because I would have had to grab for each of these categories the 4 metropolitan regions and population weight them to come up with these same lines. It would have been a lot of work. This report as is probably 60 hours of work as it is, and you know, there's a few other interesting side projects we could do here, but I chose not to do them because I didn't think they were relevant. Continuing on, we look at the similarity index. This is just to see what parts of the CPIs are similar. This doesn't tell us which one is contributing more or less. This just literally says to us, for these time periods, what categories are most similar. And so we can sort of see the same basic information that we found in the 2016 report. Now, in 2016, other goods and services was the second highest in terms of the similarity index. Since 2015, this other goods and services has really jumped up, and in fact, it's more different than housing at this point. So that would be another little interesting side project to kind of delve in to see what that is. But I didn't do that. I follow the same method to construct these new CPI indexes so we can decompose the differences between them. That's what figure 15 shows. This answers the question, what is driving the differences between the CPIs? And here we look at Beta West, West to the Pacific, and the Beta Pacific to try to figure that out. And as the graph shows, Beta West has some interesting results here where housing is close to or above 100% of the difference between the indexes. But we've got transportation, recreation, and apparel negatively contributing. So they're lessening the difference between the Bay and the West. When we look at the Pacific, I think a little more interesting is that the West to Pacific and the Bay to Pacific, housing is roughly half in both instances, and we no longer have any negatively contributing subcomponent.
Trustee Harris.
Question, Robert. Listening to Mr. Almeida and the increases that he has had in his CPI, and he's grateful for the 3%. Yesterday, I went last night to a meeting to protest a 43% increase in water rates in our area. And yesterday in the mail, I received my insurance for my home that increased 300% in actually a little over a year. It's been from 22 now to 24, 300%. Where do you show things like homeowners insurance? Is that part of the housing graph?
Yeah.
Okay. Should be shooting up a lot higher than that if you get a 300% increase on a retired teacher's salary.
Yeah, you know, I can't necessarily defend BLS's methodology. It sort of is what it is. But to do part of this analysis, I did have to go grab these things called importance factors, and that's buried in there. You know, I don't know exactly the breakdown of, you know, homeowners insurance in that instance, but I would assume it's very small. You know, I mean, 0.00 something in terms of contributions, when housing itself as an importance factor is close to 43% of the U.S. city average. So within that 43%, 0.00 something, I can get back to you on what it is.
It's just a point. It was a real shock.
Yeah, and I've seen, you know, news reports where they highlight some of those really deep in subcategories like juice or something that's buried in food and beverage, you know, and so you've got a 30, 40, 100% increase in something like like frozen juice, for instance, month over month or year over year. But the contribution that it's making is 0.0008, you know, so that's a number that I've seen reported. The juice one is standing out in my mind as 30% in a month. Well, you know, that doesn't mean the whole CPI went up that much. The contribution is extremely small. So I can get back to you and answer that. We definitely have that on the saved drive. I know I have it.
Yeah, you don't have to. I'm just browsing. Since we don't get a 3% compounded interest rate, it really is, it looks substantial to me. Our retirees definitely deserve it, but when you get an increase like that and you try to figure out on a teacher pension how to pay for it, not fun.
In a perfect world, I would want to use housing, some kind of housing, food and beverage index, and medical care indexes to really zone in on this. But I think, and as the numbers farther down the report show, you know, we start to really get into splitting hairs here, and there are a number of assumptions involved in terms of what's the best way to measure inflation in Mendocino County. So we'll just keep on going. Now that we sort of know that housing is a large contributing factor to all of these regions, now we're going to try to figure out, you know, which one of the regions' housing values or fair market rent values most closely match Mendocino County, and that's what the bulk of this report goes on to look at. We population weight the indexes to try to make these comparisons. Figure 16 shows the Zillow Housing Value Index for 2000 to 2023. And this has all the regions that we're going to look at. This one thing I would also point out is that the Zillow data now has been updated in terms of methodology since the 2016 analysis was done. However, this report, this graph still does show the basic outline of the curves. This particular graph here, we don't really care what the value of the curve is. We don't care that the Bay Area costs, you know, $800,000 or $700,000 versus Mendocino County home costing $300,000 or $400,000. We care about how does that curve change over time and which one matches the closest. And so, by my eye, I can guess that the Pacific region, the West region, and the California region, based off this graph, appear to be the closest fit. The Bay Area region, while similar, really starts to, you can see the width between the lines increase as we get into 2014, 15, 16. Whoops. This gap between these two gets bigger. And then, of course, we've got COVID coming in here with pulling these down. And we can see that slope is decreasing. This slope here is more angling downward than the other regions. although it does look like it's closer to Mendocino County. But instead of just looking at that, we want to try to figure out really what's the deal here, which one really is the closest. That's what these other figures do. These are scatter plots. And if we were to draw a line sort of through the middle of all of these graphs, we could decide which one of these closest matches Mendocino County. Which line have the dots closest to the line would be what we're looking at here. And so this is kind of hard to visually inspect, frankly. In order to get around that, we look at the correlations for each of these regions. And Table 2 here shows the correlations for Mendocino County versus the other regions for the Zillow Home Index. And theoretically, we would want to see numbers closer to 1 to explain the change in home values for each region. And so this shows, based off this one metric, that the closest value to 1 is Mendocino and the Pacific region. So I note that. If we look at rolling correlations from 2000 to the year in the graph here, so from 2000 to 2009, we've got rolling correlations of between 0.96 and 0.99. That's fairly high. That's just telling us that the variability in the data sets are being explained 90-something, 96%. 4% of the variation in the data is unexplained. So we can look at this over time. We see that 2 lines are sort of outliers here, Bay Area, Mendocino, and California, Mendocino. That's not that surprising, given that we know the housing is a large part of these indexes. And we know that LA and the Bay Area you're going to find more expensive housing down there than Mendocino County. So we can see that those correlations change a little bit time.
And with those correlations, you can see that ultimately the West region is the better fit, although they're all very, very close. Any of them are a reasonable index to use, but the tightest fit does happen to be the Western region over time.
In this case, yeah, you can see that they're really close. So then we look at the other metric here. What are the growth rates? What's the geometric mean growth rate? What's the CAGR? That would be the CAGR rate. What's the log linear regression growth rate? And so we can see for 2023, Mendocino County CAGR is 4.52. Our log linear regression is 3.62. The difference in these two growth rates is one only looks at the start and end value, that's the geometric, and one looks at the path followed. So, path followed, in my opinion, would be more accurate and more closer of a fit. But for both regions, we can sort of see different numbers here, which again, I think this is very interesting. I didn't delve into try to solve the mystery of what's going on with Zillow Housing Index and why these rates look this way. But we can see that on a more consistent basis, it appears that the Western region has a growth rate that's similar to Mendocino County. But to be fair, California and the Pacific region aren't that far off. The Bay Area is an outlier when you look at the path, but when you don't look at the path, the Bay Area has the closest growth rate. Lastly, we look at these regression results to try to see how close is a linear model to fit the data. And in this case, they're pretty close. If you were to take a stats class you know, when we're above 0.9 on an R squared, everybody's happy with that. This significance value is also what is typically reported as the confidence level. And we can see that these confidence levels all are extremely small, well above 0.01% confidence. So we can be pretty confident here that the housing values are a good measure of that the changes in the housing values closely approximate each other. Finally, we drop the intercept, and now we say, okay, well, let's just imagine that we have a zero intercept in the model, and we redo the same estimate and calculation to see if we have a better fit, and indeed we do. We can see the R squareds are higher, and we can see these confidence levels go up. Again, they're well above 0.01. Finally, we look at the elasticity measurement, which tells us the changes in growth rates for housing in one region to the next. And if we were to, if these numbers are closer to the same number, that means that as one region changes, another region changes just as much. And so we've done that test down here for each region, and this is, again, sort of interesting. I feel like this is calling in, for me, this is calling in the question of the Zillow Housing Index, and I'm wondering, how are they calculating some of these numbers? You know, there's a methodology behind there that I don't necessarily understand, but Pacific region here is closest to 1. So we want to see a number that's close to 1. For every 1% change in one region, we see a 1% change in another region. Mendocino Western region is not close, it's not that far behind at 1.006. And so the results of the Zillow test here show that either the Pacific or the Bay Area in these three tests are the closest comparators. You know, which one is it? I think you could flip a coin between those two when it comes to the Zillow Housing Index. We do the same analysis for HUD, and I won't go through all of that conversation here, but I will show the rental rates for HUD, which, you know, they're a little more spread out, but again, we're not looking at the height of the graph here, the line. We're looking at which lines follow each other the closest. And so we do that those same tests again to determine who's got a better correlation, which correlation is closer to 1. And we look at, so that would be this graph here, the same rolling correlations. Again, they're all pretty high, and we've got this outlier here in Mendocino, or in the Bay Area. If we keep going, if we look at the growth rates here, Mendocino County's log linear growth rate is a 3.11, and the closest region to that growth rate, the Western region. In this instance, we can see that Mendocino County and the West are actually closer on HUD values. We continue the estimate here to look for the elasticity, and we want to know which one, again, is closer to 1. And in this analysis, we see that the Western region is a 0.972. That means that for a 1% increase in the Western region, Mendocino County would see a 0.972 increase in fair market rents. And so based off of those three tests for both regions, My recommendation, putting more weight on the HUD data, would be to have the board use the Western region for granting CPI to retirees. COLA increases. Continue to use.
Is there discussion? Trustee Harris?
My only discussion is you may want to send this to James Wilbanks. He and I had a real argument over continuing to use the Bay Area, and I said we're way behind them. And so he did his own research, but for a science geek to do what you have done here, I think James would be most appreciative if you would give him a copy.
I can definitely do that. Yeah, I mean, I added a few things and I expanded a few items, but I really followed his entire methodology to do this. So I certainly wouldn't have been able to complete this work without being able to review his files.
Yeah, so for those of you on the board, 5 years ago, most of this may seem very familiar because Robert followed right along with the format that James had provided and just updated that information. The recommendation is that we continue to use the Western region. The only other question I would have is whether or not you want this brought back again in 5 years, or if you just want to wait and give direction on when you want to review this as opposed to have it on a set schedule. The last one's just board direction. The important thing is whether or not you want, I think we need a motion to adopt the CPI region.
I'll move to adopt the Western region.
And I'll second.
Judy, could you do a roll call vote, please?
Yes, Mr. Land,
Aye.
Ms. Cavness,
Aye.
Mr. Kelly,
Aye.
Jurdy,
Yes.
Mr. Shoemaker,
Aye.
Ms. Harris,
Aye.
approved.
Okay.
Wasn't there another question about whether we wanted to bring that back in the next 5 years?
Yeah, I was actually just curious. That would be board direction.
Right.
I do have a recommendation, and I do think, consistent with your fiduciary duty, these numbers do change, and
Yeah.
I would recommend that you do review it again in 5 years.
Change them.
I don't think that requires a motion. The current
Direction
practice
to
is to
staff.
have this brought back every 5 years. It's
Okay.
really a question of how frequent. I wouldn't recommend going any shorter.
I wouldn't either, and it is a lot of work, but I'm not wedded to the 5 years. I think it could be 7 or some other number, but I think you could just give direction.
Okay, direction to staff.
I'll just go ahead and leave it at the 5 because I'm different.
Okay, discussion and possible action regarding compensation earnable and pension compensation resolutions.
Thank you, Chair Cavness. There's a memo and ordinances or resolutions in your board packet. This is a modification of an existing pay code to change it from a sheriff department incentive to a broader incentive recruitment pay code that then HR could use whenever the Board of Supervisors adopts an incentive rather than having to create a new specific pay code. So this code would just change it to be broadly more applied. It's a recruitment incentive for specific positions when the Board of Supervisors authorizes such action.
I would move to approve.
The motion.
I have a question first. What's the difference between the compensation phraseology used for PEPRA and non-PEPRA members?
Yes, thank you.
I noticed that, and I was curious why those are differentiated.
They're differentiated because the county employees retirement law uses the phrase compensation earnable and defines what can or cannot be included in compensation earnable, which is the compensation used for the benefit calculation. With the PEPRA regulations that went into effect on July 1 of 2013, they have a new definition of compensation and what can or cannot be included or must be excluded. And so they call that pensionable compensation for the PEPRA members, and it's compensation earnable for our legacy non-PEPRA members. And we're taking those language directly from the code.
Okay. And one other question. Basically, what we're doing here is defining pay type 510 to not be pensionable for anybody.
That's correct.
Thank you.
But there could be instances where it might be pensionable for one group and not for the other, so that's why there are two resolutions that are being adopted, but this particular pay type would be non-pensionable for everyone.
Gotcha.
So I think we had a motion.
I'll go ahead and second that one.
Okay. Judy, roll call vote, please.
Mr. Land?
Aye.
Ms. Cavness?
Aye.
Mr. Kelly?
Aye.
Mr. Jurdy?
Yes.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Okay. What do we have to do? That was for both of them.
Yes, that was for both
Okay.
resolutions. You don't need to do a separate motion.
Okay, so quarterly budget update, Mr. Reveles.
Trustees, you have the quarterly budget update and memo. I'd be happy to answer any questions.
Okay, so this is receive and file. There's no questions or discussion. Is there any public comment? Seeing none, moving on. Discussion regarding administrative report, Executive Director Rentschler.
Thank you, Chair Cavness. I have a couple of updates to brief the board on. The first is the upgrade to MSERA's board conference room are almost complete. They should wrap up next week. At that point, the board can decide whether or not to return to the MSERA conference room. It could easily be included or returned there as early as April. MSERA contracted with Poblowski Research, who sent out emails to all of our memberships with whom we had an email address on file to ask about the preferences in our communications and education and services that our members are receiving. I hope to have an update on that survey for the board at the next meeting. As trustees, you had an opportunity to talk with Larry Jensen with Audit and Risk Management Services. He's the consultant hired to perform an enterprise-wide risk assessment. And with the completion of the staff and trustee interviews, we'll be developing a series of risks that MSERA should be considering when evaluating our strategic objectives, our budget, and our internal controls. That report is also tentatively scheduled to come back to the board in March. If you received the county employee emails on upcoming trainings, you might have noticed that MSERA's pre-retirement seminar was included in the county HR's notice regarding upcoming trainings. I did reach out to county HR to see if we could get listed in their upcoming trainings to further penetrate into our membership with the county about upcoming activities that MSERA is working on. And next week, I expect the separate accounts upgrade to be released to our test environment so we can finish productionalizing that hopefully by the end of March. If you have any questions, I'm happy to address any questions.
Trustee Jardy?
Yeah, so I just want to thank Doris for reaching out to HR. I think that's great that they're getting some educational information included in the HR emails, because not everybody opens up the MSERA retirement newsletter, although they all should. And then the other is, so can you just explain a little more about what in the pension gold update relates to the tax update? What would that be?
Oh, every year there's a release to update for formatting of tax forms or for any other tax changes that the IRS has released, whether it's a change in the withholding brackets to calculate how much federal income tax is withheld out of their check. So those tax releases go in every year.
So not being someone who's receiving a pension, so are you saying that, that the software enables the member who's receiving the pension to adjust their withholding, or is that just automated in some way?
Members can actually complete a form or do it online through Member Direct to change the amount of tax withholding withheld from their monthly pension benefit. The underlying tables that actually calculate that amount, in the old days it used to be based on marital status and number of exemptions. Now it's based on percentages and total income, but that calculation is done within Pension Gold to determine the appropriate amount of holding based on what the member selects when they complete their tax form. Did that answer your question?
So members are interacting on an annual basis with the software now, and or is there a training that they go through?
They don't actually interact with it. They would just complete a form regarding their tax withholding, and then Pension Gold applies the formula to determine how much is withheld from their benefit payment. I believe Member Direct may have a paycheck illustrator, so if they change their tax withholding, it might give them an illustration of what the net was. Do we have that?
Yes, they actually have an example of the W-4P form. There was some small changes made by the IRS to that form that has to be moved into Member Direct so that the form is identical to the government form, and then that the members are able to do a what-if calculation.
Okay, I guess the reason why I'm asking, because it seems quite likely that a number of members might collect the pension prior to electing to collect Social Security. And so their taxable bracket, their taxable income would be lower prior to pulling the trigger and collecting Social Security. And so I'm just curious if it would be advisable for a member to kind of think that through and realize that, okay, they're collecting the pension now, 7 years down the road, they're going to collect the Social Security. They might want to go back and readjust 7 years later. I don't know.
Yeah. I would recommend to someone, if they have a significant change in the amount of income, whether it's that they're working a part-time job or they started receiving Social Security benefits or anything like that, that they complete new tax forms, both federal and state, to ensure they're having the appropriate amount withheld. Now, if they didn't with us, but they certainly can elect to have federal withholding from a Social Security benefit or from wages at a job, they could still adjust for that on that side, but I would suggest that people review that in total to make sure that they're having adequate withholding and they're not subject to the penalty for not having enough federal tax withheld whenever there's a significant change in their income.
Part of our member counseling includes notifying the members that they can make tax withholding changes at any time, and we do discuss the taxability of Social Security.
And we do process tax changes all year long. It's not like a once off. You can make that change at any point in time. And we do run even something in our newsletter periodically reminding people of potential tax changes coming through and that they might want to review their withholding. This is just a receive and file, Madam Chair?
Yes. And then the other part B, the Sackers legislative update, is there anything specific that we need to discuss there, or just the receive
I
and
did
file?
have the Sackers legislative update attached for your reference. There was not a lot in this one. It was really talking about the change in leadership and the change to some of the committees' leadership also, and when bills can be brought forth. It was really just a reference that didn't talk to any specific legislation currently pending.
Thank you. Okay. The general member discussion. Is there any general member discussion, any training or other items anyone would like to update the board on? Seeing none.
Comment.
Public comment. Is there any public comment?
There could be.
Nope, there's no public comment at this time.
Okay. So the board is going to go into closed session for the following items. Service-connected disability, application Jesse Van Wormer, Sheriff Deputy 2, pursuant to Government Code Section 54957B, and conference with real property negotiator pursuant to Government Code Section 549568.8. And the property is 625 King Court, Suite A. Negotiator is Doris Rentschler.
Yes, we'll adjourn to conference room C. Move to conference room. Conference room A.
A is an apple.
Okay.
Move to the bathroom.
I'm bad today. Giving break.
I'm not sure if this version that I had both.
Yeah, indeed.
I can certainly, and with Robert's net present value, I think we got it. I thought he made the changes.
I wasn't sure if you
Upright.
got the numbers back, but what I was getting at. That they're gonna that was the.
Okay. Thank you.
I didn't feel comfortable repeating.
I did not
Sure I'm
get a
back.
chance to
Right,
put
and
that
that's
in the
okay.
memo, but I do understand what you're saying.
Turn my text on and I won't.
You want to come board item, right?
Yeah.
Research and report.
I've got to be tougher than her.
Why? Being tough doesn't serve people very well.
Really is an advantage to sitting here to be able to see a screen.
Yeah, it's more spacious.
I'll try to.
That happened to mine too.
I will know where to put my,
They don't lock.
where to put
Why do you lock?
my left hand.
Okay. Okay, we're returning to open session, and Council Burke will report out.
Thank you. So on item 11A, the board voted to grant a service-connected disability to Jesse Van Wormer. Trustee Jurdy voted no. On item 11B, conference with real property negotiator, direction was given to staff and council.
Okay. The next board meeting is Wednesday, March 20th, 2024 at 8:30 a.m. and the meeting is adjourned.
Job, Madam Chair.
Oh, I got cheat notes.
Wow.
Nice. Even the counselors, I never got cheat notes.
Well, because I was doing